Let's take a quick look then at the US futures after you have a bit of a pullback across European equities yesterday. The FTSE 100, of course, in focus for us today on the back of that data. Futures here in the UK pointing lower by 0.3%. DAX futures pointing to losses of around 31 points. And over in France, the CAC 40 is pointing lower by a more modest number, down currently 8 points, off by about 0.1%. The open then coming just in the next few seconds. You have the factors, of course, coming through from China. We'll see the read across that surprise regulatory crackdown once again on the tech space, when many would have thought that that was in the past. No, it is not in the rearview mirror. It's very much of the here and now. And there will be some linkages to some of the gaming companies and some of the investments, of course, in Tencent, which itself is a massive investor. The FTSE 100 currently pointing lower, currently down by about 0.1%, just in the opening seconds of this Friday open, of course. The Spanish IBEX is essentially flat, and there will be maybe, of course, a bit of a holding pattern leading up to that data point, and also worth mentioning, of course, very thin volumes likely, given where we are as we lead up to the festive period, the last day, of course, before the Christmas season. FTSE 100 currently down 0.2%. The CAC current over in France, less of a loss coming through as the futures has flagged, just down 6 points currently. And over in Italy, the FTSE MIB is currently flat. Let's flip the board and have a look at sectors then. The shakeout there. Energy, basic resources and technology are three sectors certainly I will be interested in. And there's the uplift coming through for energy. It's another strong week again, as I said, because of oil prices and what is happening in the Red Sea, with more and more of those carriers being diverted from that region. Energy as a sector up 0.3%. Banks is also gaining just a modest 0.1%. The other movers in focus for us, technology, you can see the losses coming through there of 0.2%. So that's the read across from China. And that's a story we'll get more details on. And basic resources, you did see iron ore. You have seen iron ore prices higher, as is copper. Iron ore prices up 1%. Basic resources as a sector, just seeing a bit of modest pressure so far in the session. Let's get back to the data point of the moment, which is what's happening here in the UK with retail sales diverging from the overall GDP print. Severe Horta-Acosta can give us the context and break down the details from our Markets Today blog. I know you've been thinking about this and looking at this data with a forensic lens. What does it tell us?
So you can, I think if you look at how the pound reacted, first it spiked up on the better than expected retail sales numbers and then came back down on that worse GDP revision, and now it's basically flat. So, there's kind of something for everyone here, but the retail sales figure, it was much better. Really an acceleration there heading into the Christmas period. It does suggest a resilient consumer. That's been the big story of 2023 when it comes to the UK. And again, even though it's a contraction in the third quarter, it's only 0.1% contraction. It's a shallow contraction. So even if we're seeing, some economists are saying that perhaps we're already in a recession in the UK with that latest monthly GDP report suggesting growth is again weak this quarter. So 2 consecutive quarters of contraction is a recession. It's not a very kind of deep recession. It's not a very widespread recession. Gilt yields are lower. This, for me, the interesting factor, because, I'm always obsessed with the market impact of this, is does this really change the picture for the BOE? The market is already expecting a cut as early as May. We already had priced that in. When we looked at BOE pricing at 7:30, there was no change there. So we know already that the UK economy is weak. It's stagnating. Perhaps not as weak as people thought.
Okay.
So, you know, it's kind of a balanced story here.
And, yeah, and as you say, gilt yields are actually moving lower at the front end, just by 2 basis points, but you're not seeing a big sell-off, at least yet, in terms of UK debt. So it seems the focus still is on that relative softness that we're seeing. When it comes to, we can't really end the week, and this week in particular, without talking about the cost of your Christmas meal, and the need for loyalty points or loyalty card points to kind of offset some of the pressures. Is the Christmas lunch going to be slightly cheaper this year?
It can be if you have your Nectar card, your Tesco Club card, all the cards for the grocers across the UK. So there's nothing kind of, the competition authorities is looking into this. Is this kind of a legitimate thing for grocers to do to reward people that have these club cards? But millions of people do, because there's no cost to access them. So you can have, the savvy UK shopper will have all of these loyalty cards, and you can reduce your Christmas meal by as much as 40% across UK grocers. Tom, this is if I don't know what your Christmas meal is, but the typical festive meal, we looked at staples like turkey, pigs in blankets, stuffing, Yorkshire puddings, and all the accompanying vegetables and condiments. The analysis really shows that being a loyal customer of every single UK grocer really rewards you this Christmas season. Okay, so the classic ingredients to your Christmas lunch or Christmas dinner. Meanwhile, we've got to take out the very small violins for those in the hedge fund industry who can no longer afford to buy the priciest homes in London. God forbid, what's happening? They were some of the biggest buyers, Tom, though. So, it's a kind of a two-tier market where anything priced below £10 million is feeling the impact of higher interest rates. There's some concerns there feeding into that property market. And actually, a few months ago, we looked at how these people were actually going into the rental space. That's your little violin. But homes priced way above that, they're still trophy assets. You're still seeing some of the biggest buyers, biggest transactions, especially in London, in Knightsbridge, in Primrose Hill, Holland Park, the kind of trophy postcodes. The biggest buyers were actually hedge funds, or people who worked at hedge funds, obviously not the hedge funds themselves. So it's still, the London trophy home is still attracting a lot of buyer interest, especially also from the Middle East, because oil prices are high and the pound was weak. Okay, that's really interesting, the Middle East component. And look, I love Primrose Hill, one of my favourite spots in London. £43 million, one home bought by a Citadel trader overlooking Primrose Hill. So, still pretty decent price tag. Thank you very much indeed, Sophia, to run through your Christmas lunch and the woes, maybe, of the hedge fund industry when it comes to these luxury homes. And, of course, the UK data, which is mixed, but gilt yields, as Sophia was saying, slightly moving just modestly lower, just by 1 to 2 basis points across the gilt curve. That is, of course, Sophia Horta-Acosta from our Markets Today blog, and you can get more from Sophia, the rest of the team, on the front page of the Bloomberg UK website or by typing TLiveGo on the terminal. Now, plenty of US economic data on the agenda today. 1:30 p.m. London time, we will have the US personal income and spending, core PCE, and durable goods orders, all of that data coming out, and of course important when you're thinking about the price cuts coming through for the Federal Reserve, around 150 basis points or so being priced in by these markets. Bloomberg Economics sees personal income growth rising to 0.5%, 0.5% for November, but with demand for labour softening, consumer credit burdens rising and excess savings dissipating, economists expect a significant slowdown after the holiday season, perhaps a touch of the January blues. Then at 3 p.m. UK time, the final reading from the University of Michigan Consumer Sentiment Survey. That hits the terminal. And finally, 3 p.m. London time, we're going to get US new home sales, where falling mortgage rates are likely to have encouraged people to start buying homes again. The drop in mortgage rates alone would allow the median home buyer to afford a place that's approximately $16,000 more expensive. Remember the days when interest rates in the US were 7%, 8% on a 30-year mortgage? That has come down significantly, and that is giving a bit of a lift to the home builders, it seems. There's plenty more coming up as we continue to work through the data and look ahead to what is expected out of the US later today, with European stocks currently down around 0.1%. US futures, the S&P E-minis down a little over 0.1%. Nasdaq futures looking to losses of 0.3% on the year when they've notched up gains in the Nasdaq of over 50%. Stay with us. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Happy Friday, this is Markets Today. We are 10, 11 minutes into the European trading day. European stocks off by just 0.2% so far in the session. Thin volumes expected, of course, as we lead up to the festive period. Let's check in on some of the individual stocks on the move with Joe Easton. Joe, what are you looking at?
So we've got these tech and online gaming companies absolutely hammered in the open of trading process. In Amsterdam, falling 15%. Naspers in Johannesburg down 14%. And we're also seeing a read across in Ubisoft, the maker of Call of Duty, and Embracer, another big Swedish game maker, all hit as 10-cent plunges in a number of other Chinese companies as the government over there looks to crack down on online gaming. They're focused on addiction to gaming. They say bad eyesight is due to a lot of gaming among young people, and they are looking to rein in those companies at the moment, and a lot of fear in the gaming stocks spreading into Europe this morning, as we can see from those moves. Sharp sell-off in all of those companies this morning. And in terms of the sportswear, it's another rough day. We're going to have another big red screen on the board looking at some of those companies that sell all our trainers and running clothes. Adidas down 6% now, Puma down 5%, both of these in Germany. And in the UK, JD Sports down as much as 5%. They've invested a lot of time and money in building a relationship with Nike. They've built stores in the US, spread out in Europe as well. Frasers, another one, a big Nike partner, down another 3%. Both of those hit in the UK. That's despite some pretty good UK retail sales data coming out earlier. And it is, of course, the best day of the year because the London stock market closes at 12:30. I'll be sneaking out when my team leader is not looking as soon as the market closes today. But not much joy for them. It's a short day and they're getting absolutely hammered in the trading. Some read across coming through for both of those sectors. In terms of the final board, we'll have a look. Haven't done any bad puns. I was going to say, giving you my 2 cents on 10 cent, kind of works. But let's put a sneak one in before the last day of the year. RGX, this one, overweight rating over at Morgan Stanley. It really got hammered following some weak drug data earlier this week, but MS says the fears are overdone and you should be buying that one. They've got an overweight on that today. Juventus over in football. We don't do football much, but this stock did soar yesterday following a court ruling saying that a blocking of the potential Super League in Europe is not legal and potentially spurring hopes that that could be revived. A lot of the clubs have already said that they won't actually continue it. They'll stick with the Champions League. Juventus also announced a capital increase after the close, potentially capitalising on that boost to the share price yesterday. Harbour Energy up another 4%, a reverse takeover buying Deal Wintershall assets around $11 billion. That company is only worth $2 billion. It looks like a reverse takeover. As I was saying, that stock soared 20% yesterday. It's a deal with BASF in Germany, up another 4%. And Nexty doing a deal for some care homes over in France. That one of the best performers on the CAC, up 7% in the healthcare property space. Another big gainer. So we're finishing off with some green, but obviously plenty of red in tech and sportswear today.
OK, Joe Easton, it's been a fantastic year, thanks to you, and you'll be sneaking out, possibly, allegedly, for that midday and well-earned Christmas pint. So if anyone sees him, go join and prop up the bar with Joe Easton later today. Joe, thank you for running us through some of the key stocks on the move. There's a lot to look at today. Let's get back to the macro picture, though. UK GDP shrinking in the third quarter, raising the possibility that Britain is already in a recession, and it caps, of course, a lacklustre year for this UK economy. But there was strength in more recent data, retail sales growing by far more than expected in November. Let's bring in Janet Moo now, Head of Market Analysis at RBC Brewin Dolphin. Janet, where do you land in terms of what is the most important piece of data that's come through today in terms of the market implications as we look ahead to 2024? Are you focused on the retail sales strength, or is it the contraction in GDP that concerns you?
Hi, good morning, Tom. Thanks for having me. Well, first of all, GDP data is lagging, but it just tells us that the picture of the UK economy is pretty weak. And then for the UK sales, retail sales, I mean, today's data is strong, but we shouldn't really focus too much, particularly on one data point. Particularly, I think when the retail sales data were weak, people have been blaming on the weather, and I'm surprised people are not actually saying that the cold weather is finally supportive, so people buy more winter jackets, for example. So what I want to focus on is basically leading indicators of the UK economy, and that is telling me that the UK labour market is likely to weaken going forward. For example, that's the KPMG REC survey, pretty weak across the board in terms of the surveys on hiring and wages, for example. So our view is that the UK economy would underperform, say, the US, other major economies, for instance, and the UK economy is likely to weaken or struggle. Still likely, there's still a possibility of recession. But having said that, I think since we last met, we have got the tax cuts and we've got potential for rate cuts next year and also lower inflation. So that's actually quite supportive. So the base case is still a weakening economy, but it's not as bad as we previously thought.
So, Janet, how much of that is priced into UK gilts at this point?
Yeah, I think actually a lot has now been priced in versus to previously, and we have been overweight on gilts. That has been our preference within sovereigns, particularly because we think the UK economy will underperform and the Bank of England will eventually have to cut. So we saw that the recent market movement in terms of the release of the UK inflation data, it shows that there is actually still potential for things to get priced in, right? So as long as you still get data point that weakens more than expected, and by the way, the Bank of England rhetoric hasn't really changed. I mean, the Fed, a bit of more clarity on the pivot, and investors are very excited, but the Bank of England is still pretty much keeping and trying to push back rate cut expectations. So I think if the Bank of England eventually, pivots, the stance change to be a bit more dovish, I think there is certainly room to gilt yields to fall further.
And the top line from your notes to us before this interview, Janet, was 2024 will be a year to put more of that cash to work. Where are you and the team wanting to put that cash to work above and beyond gilts here in the UK? What is looking attractive for you as you position for 2024?
Yeah, so for us previously, we have a higher conviction on bonds, particularly UK gilts, and I think that has been playing out pretty well. So I think since we get more clarity from the Federal Reserve and we get more clarity from US data that the soft landing scenario likelihood has increased, we actually turn more favorable on equities, and particularly we go more overweight on US equities, particularly because first of all, is the artificial intelligence theme that we think will continue to play out. The companies related to that theme so far has really got the earnings delivered. And secondly, is really, so we have to think about the downside scenario for the global economy. And the US is still one of the more defensive sectors out there. And on the upside, I mean, the US economy is also pretty much exposed to domestic economic growth. So either way, I think the US market is still likely to outperform other markets. So we are overweight the US.
Okay, overweight the US. US is still expected to outperform next year. In an environment of lower rates and maybe a soft landing for the US economy, how are you thinking about the US dollar? How are you thinking about emerging markets? How emerging markets and that story links to a year when we have, at least the forecasts, significant cuts coming through from the Fed?
Yes, I think if you look at the historical market playbook, right, softening dollar, which is likely, and Fed cutting is usually good for emerging market asset. But one area that would try to avoid is China. So we have already talked about that many times before. We don't believe in a China market rebound story. We think that the regulatory risk still outweigh any potential benefits of being extremely cheap. So we still hold on to that risk, and today's developments with regards to the gaming sector further reinforces our view that the government is not very investor capital market friendly. So we're holding on that view. But generally, I think ex-China, things could look a bit better because of primarily the monetary policy shift. Not just the US, but if the major developed market central banks are cutting, that usually historically is a good environment for risk asset and emerging market assets.
Janet, you have a preference, as you say, for US stocks next year. What is the tech part of that play, and where are we in the AI catalyst story? Are we just in the opening phases, or is that coming to an end?
Well, we think that it is just an opening phase. I think there's just more clarity. I think initially there's a lot of enthusiasm, which is still going on, but what we see is actually evidence of earnings delivery. We particularly actually favor the picks and the shovels play, because in terms of the AI development is in the early innings, so more and more companies will adopt it. You rarely hear a company that actually doesn't talk about how AI may potentially raise productivity and eventually corporate earnings. But the first companies that would benefit will be the picks and shovels play, because for the applications for how it improved productivity, it has yet to be proven and has yet to be seen and appreciated. So I think the picks and shovel play would be the better ones to get involved with. But anyway, I think for the US sector overweight, we are generally favoring tech because that's the innovative sector that delivers earnings, and it is an area that we're relatively more comfortable with. So we think that this has the potential to drive great medium to long-term returns.
Okay, Janet Murray, Head of Market Analysis at RBC Brewin Dolphin. Thank you very much indeed, and have a great Christmas and New Year. Coming up is China, Nike's Achilles heel. We bring you that story next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Markets Today, 24 minutes into the European trading day. Welcome back. Now to a big corporate story of the day. Nike saying it's looking for as much as $2 billion in cost savings by dismissing workers and simplifying its product lineup. This after results in the key Chinese market fell short of expectations. Let's get the details then with Bloomberg's consumer reporter Tim Lowe from Munich. Tim, good morning. Thanks for joining us. Nike shares down then, taking a hit on the back of this. Investors clearly concerned. What is the concern that they're focused on?
Yeah, so the two big factors that they're concerned about that Nike has flagged as they lowered their kind of revenue forecast for the next 6 months. It's global economic uncertainty. That continues to be a question mark. But zeroed in is China. This is a place that, Nike and companies like Adidas and others have struggled with in recent years, amid boycotts and other problems. But in the last year or so, Nike has particularly had kind of a nice rebound story, building momentum there. It's once again turned into a real engine for their growth, along with women's apparel and shoes. And a lot of people around the world are wondering, is the Chinese consumer holding up? What's going to happen in 24 and beyond? And yesterday, Nike really kind of caused a lot of concern in investors that maybe it's not looking as good as they had hoped. In the next 6 months, they've downgraded their forecasts, and China is really the geographical spot that everyone's zeroing in on.
Tim, what is the company response then? What are they doing to kind of adjust to this pressure that's coming through?
Yeah, they want to bridge the gap. And this is a company that, they've had a lot of financial discipline in recent years, but they introduced yesterday another $2 billion savings plan. Now, where's that going to hit? That's going to hit like employees, mid-level managers, et cetera. A lot of costs being flagged for, letting some workers go. They're trying to take some of that savings. They're investing it into a lot of automation, speed up product pipelines and innovation. They are the dominant player in the world when it comes to athletic footwear and apparel. And so they're trying to kind of use the scale they have and the vast resources to try to even speed up that innovation cycle more. So big savings cut once again coming, $2 billion in the next couple of years. Yeah. They're trying to parlay that into growth.
Tim, we've run out of time, but we appreciate the take on that data, the results at least, and the outlook from Nike and the response there. Tim Lowe out of Munich. Stay with us. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand.
The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. This is Markets Today. We are 30 minutes into the European trading day. Here are your top stories. Gaming companies level down after China cracks the whip once again on the sector, driving Tencent holder Prosus lower by double digits. Sportswear also takes a hit in Europe after Nike earnings missed the mark amid warnings of ongoing challenges in the key Chinese market. Plus, UK retail sales grow by far more than expected in November, but revised GDP data for the third quarter leave recession risks on the table. We check in on these markets then with UK GDP and retail sales data still in focus for us as we look at the FTSE 100, currently down just 0.1%, a shortened trading day, of course, for UK stocks today, 7,688 on the UK benchmark. Over in Germany, the DAX is essentially flat at 16,682. Across your European benchmark, 476, flat across the European benchmark as we look to close, of course, ahead of the festive season. The context around the DAX, of course, is that you've seen gains of around 18% year to date, a very solid year for the German index, despite all the concerns about the economy of Germany. To some extent, the stock story diverging from the economic fundamentals of that country. And here in the UK, of course, as we mentioned, retail sales coming in much stronger than expected in November. So the consumer relatively showing strength despite that cost of living crisis, and to what extent that cost of living crisis is starting to ease is how we think and how we tie that story to expectations around the BOE. The GDP print, though, showing a contraction of 0.1% quarter-on-quarter in the most recent print. Let's have a look at the sector play out then. Technology is in focus for us today because another big story is this renewed crackdown that came out of, at least it seems, the sidelines from Chinese regulators. A bit of a surprise coming through, and you see, of course, companies linked to Tencent Process via, of course, Naspers has about a 25% stake in Tencent, a major e-commerce and gaming company with investments, global investments, and that company is down double digits in the Asian session on this renewed crackdown around gaming. And you are seeing the ripple effects across the tech sector, as a sector currently seeing losses of around 1.2%. You're also seeing consumer products being hit by around 0.9%. The retail companies, the likes of JD, the likes of Adidas and others, Puma, down on the news that Nike has revised lower its outlook and is looking to push through potentially cost cuts of around $2 billion. So some concern there around the outlook for some of those big retailers as well. The links between what's happening in the US and some of their equivalents and competitors listed here in the UK. Travel and leisure down about 0.1%. Top of your list today is energy, currently up 0.5% as a sector. Worth flagging what's happening on the oil prices. Again, you're seeing gains of more than 1% now on Brent at $80.29. Let's get back to what's happening in terms of the politics, at least the trade links and the financial links between the UK and Switzerland. They've signed an agreement to recognise each other's laws and regulations in financial services, easing post-Brexit market access for the sector. We spoke to the UK Chancellor, Jeremy Hunt.
We've had a lot of discussion post-Brexit of people, banks, operations potentially moving out of London, but it hasn't materialised on anything like the scale that people predicted. London has shown itself to be very resilient. And if you look at what's happened in the last year, what we've done in the UK is we've shown we're going to be hungry to keep all that business that's come to London. We are very committed to financial services in the UK. We passed the Financial Services and Markets Act. We are changing the rules for prospectuses and for all sorts of the rules around IPOs to make the London Stock Exchange more competitive. We've got the Mansion House reforms, which is going to unlock a lot of capital into growth businesses from pension funds. So we are really motoring in the UK. We're hungry to attract business all around the world. And this deal with Switzerland is just another step in that direction.
How much are you looking to some of these revenues, though, to be able to enact tax cuts? You were talking about additional tax cuts coming down the pike. Are you still planning that? And specifically, where are you planning to have those tax cuts? Is it going to be with the savings or property, other areas?
Well, Rishi Sunak and I have said that we would like to cut the tax burden more if we're able to do so. But we won't be in a position to do that until much closer to the spring budget. We haven't announced a date for that yet. But, you know, we won't find out what the latest forecasts are from the Office of Budget Responsibility to know whether we're in a position to do that for some time. But we would like to bring down the tax burden in a way that is responsible if we're able to do so. But right now, our priority is to bring down inflation.
OK, that, of course, was the Chancellor of the Exchequer, Jeremy Hunt, speaking to us at Bloomberg. Now, staying on the UK and the economy here, shrinking by 0.1% in the third quarter, raising the possibility that Britain is already in a recession. But better news from the more recent data, with retail sales gaining 1.3% in November, beating estimates. Joining us for the analysis then is Dan Hansen from Bloomberg Economics. Dan, talk us through this data. You warn us about the volatility that comes through from retail sales. Yep. What is most important for you? The focus on GDP, the focus on retail sales? What are you reading from the print that came through?
Yeah, so I mean, the fact that retail sales is for November, you probably have to put a little bit more weight on that, right? The fact that the consumer looks like it's potentially turned a corner. There is some risk, I think, with the retail sales data that some of that spending has been brought forward from December, so we have a bit of a weaker December print. But I think the big picture here is the weakness of growth that we've been talking about for a long time is probably going to be a story for early 2024. But as we move into the spring and into the second half of 2024, I think we'll actually sort of move past this story and move towards something a little bit more positive. And I think the big reason I think that will be the case is what we found out about inflation this week, which I actually think for the outlook is probably the most important thing we've learned. And what we've learned about gas prices and things like that, I think we could well see inflation down at 2% around the spring. And that will obviously be a massive boost to household real incomes, a massive psychological boost. And I think, you know, as I say, we'll move past this argument about are we or are we not in recession. OK, inflation potentially at 2% by spring of next year. We heard there from the Chancellor, Jeremy Hunt, saying that, you know, in his view, the medium-term outlook for the UK is rosier and brighter and more positive, more optimistic than maybe the data suggests. Do you align with that view, or would you push back on that? So relative to what we've had over the past 18 months, I think it's certainly brighter than that. I mean, I think if you think of sort of about the economy's long-run growth rate, what its potential growth rate is probably somewhere between 1% and 1.5%. Now, we've been knocking around at zero for a very long time. We've been having this debate, are we not in recession? So yes, relative to that, I think the long-run prospects for the economy are better. But obviously that 1.5%, if you compare that to what happened prior to the financial crisis, where the economy grew at sort of 2.5%, 3%, it's significantly weaker. So I think, it depends how you look at it. It depends which way you cut it. But I think from where we are now, there is room for growth to accelerate, and not in a way that lets inflation back out the bag.
Okay, and you talk about inflation, you talk about the importance of the inflation that came through this week, and maybe expectations so you get to that 2% target as soon as April of next year. What other data points are you looking for as we edge into and towards 2024? What's going to be central to Unity?
Yeah, so I think, first of all, wage growth, and also in the first quarter of 2024, it'd be really important to see how wage settlements evolve. That'll be really key for the Bank of England and the timing of the first rate cut. And also, going on the inflation point and sort of going into the detail of the inflation numbers, services inflation, because we know that's what the Bank of England is really, really focused on. And if those two things begin to come off, I think it'll sort of augment this picture around the headline rate, which will be a lot about energy prices. So they'll want to see evidence that underlying inflation, domestically driven inflation, so services, wages, are coming down, and they'll continue to be the two things to look at in the first quarter of 2024.
Okay, continue to keep a laser eye on wages and services here in the UK as we look to see if that confirms the headline print, of course, and the headline view around softening inflation, or at least less inflation here in the UK. Dan Hansen from Bloomberg Economics, thank you, of course, for the take on the retail data, the GDP print, and a preview of what to look for in 2024. Stay with us for plenty more. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise?
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Welcome back. Happy Friday. This is Markets Day, 42 minutes into the European trading day, and you are checking in. We're checking on the European benchmark, currently flat across European stocks. US futures, S&P even is pointing lower by just 0.1%. A redhead that broke just in the last couple of minutes from Japan. Japan planning a 10% reduction in debt sales for the next fiscal year. So as we expect a huge amount of issuance coming through from the governments of the US and the Eurozone, Japan is actually planning to reduce its debt sales in the fiscal year by 10%. So we continue, of course, to monitor the JGB reaction to that. The 10-year currently at 62 points, currently 62 on the Japanese 10-year. The Japanese yen, not all the movement on the back of this news. We'll keep across it for you, of course. 142 on the Japanese yen, just down 0.1%. And all of this, of course, as speculation remains as to when the BOJ will move out of and beyond its negative monetary policy stance on the back of course, the BOJ meeting and decision. They held pat in their most recent meeting and gave no clear clues and no clear steer as to when that decision will come. They keep an eye, of course, on wage inflation. We know that in Japan. Again, the headline, Japan planning a 10% reduction in its debt sales for the next fiscal year. Let's cross over now and get more on what is happening on the continent of Africa. The World Bank says that Africa has gone through quite a lost decade as debt payments and lack of access to capital take resources from education, health and the environment. IMF data shows African nations' debt to GDP ratios have doubled since 2013. Let's bring in now Bloomberg's Africa economist Yvonne Mungo, who is live for us in Johannesburg. Yvonne, why are then several African countries back to being highly indebted?
Well, that's due to significant borrowing over the past couple of decades when we had low U.S. interest rates. We had a lot of global liquidity searching for yields, and a lot of that came to Africa through bondholders and also China increasing their lending to Africa, and it's resulted in several African countries running up their debt positions, and that's why you have it sitting at double of what it was a decade ago at over 60% of GDP. As a result of that, we've had a couple of countries default on their debt since the pandemic. That includes Zambia and Ghana. More recently, Ethiopia also appears to be defaulting on their Eurobond coupon payments as well. We're now looking forward in 2024 when we have some Eurobond payments due, in particular Kenya, which is expected to pay its $2 billion Eurobond in June of 2024. And of course, everyone's watching to see if they'll be able to meet that payment. We also have the IMF concerned about several African countries needing to restructure their debt, given how highly indebted several countries have become. So at least 8 countries are in a position where they will need to restructure their debt, given that they're at high risk of debt distress.
Okay, so some restructuring is potentially in the pipeline for some nations, at least next year. What is their ability to access funding now across the continent? How available is that funding, and how much of a struggle is that for some nations?
So that's what's changed for Africa. So pre-pandemic, for a couple of decades, we had a lot of cheap dollar funding coming to the continent. But of course, over the past 2 years, we've seen a sharp increase in U.S. interest rates. We've had outflows of financing going back into advanced markets. And as a result, that's resulted in a funding squeeze. So a significant tightening of foreign exchange liquidity on the continent. And the impact of that has been currencies depreciating. We've seen quite significant devaluations of currencies on the continent. And this year alone, Nigeria's currency, as well as that of Malawi, has depreciated by 50%. Angola's currency is down also 40%. And the Kenyan shilling, Kenya, the country that's due to prepare a Eurobond next year, has also seen its currency depreciate by 30%. And that's all reflecting the significant decrease in foreign financing coming into the continent.
What is the inflation picture looking like?
Now, as you can imagine, since the import component of our CPI baskets are pretty sizable, we've seen inflation accelerate on the back of that. We have Nigeria and Ghana of inflation of over 20%. So they're a significant way off considering any rate cuts. If anything, countries like Nigeria will tighten in the first half of the year, given how high inflation is. Kenya and South Africa have managed to bring down their inflation rates back into their target ranges. However, they're still trying to bring them lower to meet the midpoints of their target. In South Africa's case, that's 4.5%. We expect that to be achieved towards the end of this year. But as I mentioned, South Africa is probably one of the countries in a better position where they are seeing a turnaround in inflation. It's starting to slow, but we still have several countries with pretty high inflation, and that's due to weak currencies.
Okay, Bloomberg's Africa economist with a smart take on the funding challenges, the inflation challenges of a number of nations across the African continent for us. Yvonne Mungo in Johannesburg, thank you for the detail. Let's switch focus now to what is happening and what has been happening in the tech space, and of course with a lens on artificial intelligence in 2023. The year has been, of course, a year of the generative AI boom, with the likes of NVIDIA and industry leaders posting huge eye-watering gains. Joining us for more on this is Bloomberg's Mark Berg. And Mark, when you reflect on the highlights of 2023, the progress that we've seen in AI and how the semiconductor makers have adjusted, what stands out to you?
You know, what major thing we're seeing is that we're seeing these chip companies become major investors in startups. NVIDIA, Intel, Qualcomm, these companies are getting on the cap tables of some of the hottest and kind of generative AI companies that we're seeing. And I think that is like the cloud providers, you know, they're getting this arrangement where they're basically saying they're setting it up for the chip companies to have this tight relationship, a strategic partnership with these firms that are spending a lot of money on their chips. But it's also kind of, they're skating ahead with where the puck's going, and they're getting, I think, much more active as strategic corporate investors in ways that they haven't been in the past.
That's really interesting on how active some of these semiconductor makers, the likes of NVIDIA, have been within the investing space and within the startup ecosystem. What other trends have you seen, Mark, you and the team, and how might some of those trends kind of filter into next year?
We're certainly seeing the chip space continue to be a geopolitical story, right? We are seeing the continuation of the trade war from the U.S. and China, and then China sort of retaliating on its side. I think Europe will be in this really interesting position where they're kind of sitting in Europe and in the Middle East in particular. There's been this big appetite for AI coming out of the UAE and Saudi Arabia. These are countries that have a lot of money to spend. They're really interested in diversifying from away from oil. And they are actually much more willing to partner with Chinese technology companies than, say, the U.S. has been. And so I think going forward, we're going to see a lot more regions and like nation states become actual players in buying up a lot of this chip infrastructure and building out data centers. I think that they'll sort of strain the capacity from companies like NVIDIA. That's where we still have a scarcity around these GPUs. And some of these NVIDIA competitors will most likely start to gain some traction.
The EU took the lead in terms of AI, arguably, in terms of AI regulation, I should say, this year. How do you expect the regulatory environment to change in 2024, Mark?
It's really interesting that the EU law is still being worked out. I think it's certainly not as strict as it was in the past, or it was initially it was written. You know, as formula was 2 years ago. China has also come out and put out their own regulation. You know, the US has clearly talked about it. The UK as well. I think that so we certainly see in the UK and the US not wanting to be as restrictive as Europe has been. I think, you know, there's a lot of push to have global standards and regulation. You know, everyone in the industry talks about how this AI is kind of borderless, and they don't want to happen what has happened with the internet, where it's kind of become balkanized with the different regions and countries that have their own rules. I think it's really unlikely that that's not going to repeat, where we're going to see different regulations in Europe around AI, in the UK, in the US, and parts of Asia. And for many of these companies, that there's an argument there that the certain ones that have a balance sheet to deal with that compliance and operate elsewhere, otherwise we're going to have kind of regional players.
Okay, Bloomberg's Mark Bergen, thank you very much indeed, with a look at some of the potential touch points for AI as it continues to evolve in 2024. We appreciate it. Let's take a deeper dive, or we will take a deeper dive into the markets just in the next couple of minutes, with a focus, of course, on the UK data and a preview of PCE inflation out of the US. Stay with us. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This is Markets Today, 54 minutes into the European trading day. European stocks just off by 0.1%. Let's take a look at what else is happening in these markets. Bloomberg's Justina Lee joins us for the take with a focus, of course, on the Fed's favourite data point when it comes to inflation, at least, Justina, which is PCE. What are you going to be looking for?
Yeah, I mean, that's coming out later today. And I think what people are really focused on is the Fed going to give further confirmation that inflation is indeed slowing? And at least looking at kind of what economists are projecting so far, that is exactly what they're expecting to see. I mean, not a big drop, but kind of a bit of easing in inflation. And kind of if you look at recent trends, from the last set of CPI numbers or, the more recent producer prices numbers, it does look like everything is kind of trending the right way so that maybe we can get inflation back to the 2% target.
And we have now around 150 basis points priced in for the Fed. What are you looking at in terms of the market adjustment to lower rates potentially for this Federal Reserve?
Yeah, because I think, at this point, people have basically kind of assumed that, we all know that rate cuts are coming at some point next year. And I think the markets, especially the bond market, has already kind of celebrated that in advance. So I think at this point, the bar for kind of bonds to rally further or even like stocks to rally further is pretty high. And if anything, now that we know inflation is slowing, the debate has kind of shifted to whether it's sort of going to slow enough, whether economic growth is going to slow enough to warrant, the amount of rate cuts that's kind of priced into markets right now. And so I think the bar for disappointment is pretty low here.
Okay, looking at the bar for disappointment around the moves into treasuries and stocks as we lead up to that PCE print and how the markets will readjust, of course, pricing in around 150 basis points of cuts for 2024. Justina Lee, thank you very much indeed for the analysis. That is it for Markets Today. You can get insights from us and the team on the front page of the Bloomberg UK website or by typing TLIV GO on the terminal. Wishing you and all the loved ones, of course, a happy holidays and New Year from all of us here on the team. The Pulse is up next. This is Bloomberg.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. Here's what's coming up on today's program. The UK economy unexpectedly shrinking in the third quarter, raising the possibility that just maybe Britain is already in a recession. But take a look at the retail sales, those growing far more than expected in the month of November. Over in Asia, Tencent sinking as China cracks down on online gaming, catching investors off guard yet again. Meanwhile, over in the States, Nike stumbling and earnings miss estimates not really serving the stock very well. Sales falling in the current quarter as it warns of ongoing challenges in that key Chinese market. We're going to dive into all of it, but for now, let's take a quick look at the European markets map here, because of course there is still European trading, although I have to say very, very light, a risk-off mood across Europe. But again, take it with a giant grain of salt, because there aren't very many people at their desks right now. I seem to be the only one standing. And what's important to keep in mind here is that it's also the Friday before a long weekend, so it's only natural to take a little bit of cash off the table. I imagine that is kind of what's going to be driving the market narrative for the next few weeks at least. Joining us now, Candrium's senior fund manager, Jamie Niven, joins me on set. He's also the last one working. It's just you and me, apparently, holding the fort down. Talk to us about what January might look like.
So we've seen a lot of the performance that people probably expected for 2024 already in December and November. The bond rally that we've seen has been very impressive. I think in January we might start to see some pushbacks from some central bank officials. Certainly we've seen that post the Fed meeting, where some of the FOMC members have come out and said that market expectations are maybe a little bit optimistic in terms of the timing of the cuts. So I think January might be a little bit more volatility. I would also expect a bit more supply in the bond market, which might have a negative impact on yields. But generally for 2024, we're still quite positive in fixed income markets.
Let's talk about that supply of the bond market as well, because in the last hour or so, we specifically got headlines coming out of Japan saying they're going to be cutting their debt sales for fiscal 2024 by 10%. This is coming in the face of already scrutinized monetary policy over in Japan. I think when people think of Japan, they kind of think of it as an isolated case. It's kind of the anomaly in central banking, but I would argue there are global repercussions to it. What do you think?
Certainly there's been lots of discussions about Japanese buyers of overseas bonds and the impact that has for the Treasury market, for the OAT market, for example, for the Australian bond market, where Japanese investors are large holders. I think that's quite well flagged in the market, and it's because it's been talked about so much, it's almost baked into expectations. In terms of Japan as an entity or as an economy, We do believe that it could be the only central bank who raised rates in 2024, given the very, very accommodative policy that we have there and the very negative real rates that exist in Japan right now.
Talk to us then a little bit about the liquidity picture, because that's another one that's really plagued bond markets, I would argue, for the last 2 years or so, but really intensified in the last 6 months. Do you think liquidity is going to be an issue going into 2024, or perhaps is the bond market reassured by easier monetary policy? Does that kind of cushion the blow?
Yeah, for sure it does. And I think in terms of liquidity, as I said before, it's well flagged in terms of less central bank buying. Certainly it could result in some steepening of the yield curve. But if central banks are cutting rates, and if the growth picture isn't as positive than it has been over the last year, then it's certainly possible that we will see somewhat easier monetary policy and therefore a rally at the front end. I think steepening is really what we're looking at.
But then does that have some sort of read-through into the U.S. election, for example, or the fiscal debt concerns there? Is any of that on your radar, or is that kind of a U.S.-centric story?
For sure it's on our radar. I mean, I run a global bond fund, so I'm looking at everything globally, and the U.S. bond market...
My condolences, by the way, on that. Continue.
The U.S. bond market is the most important still for global markets. I think in terms of the U.S. election, that will come into focus from Q2 onwards, I suspect. Right now, everyone's still focused on inflation, growth picture, what it means for the Fed and other central banks. And then the second half of the year, I think certainly people will start to think about the U.S. election and how that might impact things. But I think really the important point that I would like to get over is that we really believe that this inflation picture will be here to stay. Central banks, particularly the Fed, have communicated that pivot. And I think other central banks will follow suit, but maybe in a few months' time, not quite yet.
So we're kind of taking a tour around the world with you, it seems. We started in Japan, Asia. We did a little bit of the United States. Let's do right here in Europe as well. And again, the last couple of days, we talked a lot about the fiscal rules in Europe getting changed. And it felt like this was one of those complicated, convoluted legal things that always ends up in EU courts. But I would argue it has a real effect on the way some of these spreads are really trading. There was already a concern, I want to say at least for years, but specifically in this last 2023, that a lot of these governments, Italy, Spain, arguably France as well, weren't able to meet some of their targets when it comes to the fiscal rules that the EU sets. Now they set new rules that are even tighter than before. Why is there not a bigger reaction here?
I think there's probably some... the fact that we're probably going into a period where interest rates aren't quite as high. We've probably seen the peak in interest rates, and therefore the pressures on these governments in terms of meeting their debt concerns is helpful in terms of that debt sustainability. Also, we've seen a big rally in equities, we've seen a big rally in credit, and we know that sovereign spreads are very correlated to both of those. So I think it's all very correlated. Actually, our view is that sovereign spreads could underperform similarly rated investment-grade credit going into 2024, Italy being the biggest at risk there. So yeah, that's something that we'll continue to watch.
But is it something that's going to have a bigger effect when we're talking about the performance of some of these European bonds, especially relative to what it feels like is a lot of momentum going into the American bond market right now?
Yeah, no, I certainly agree with that. And something else I would say actually is that everyone expects Europe to be very anemic growth next year and the US to have somewhat of a soft landing. I think in terms of our forecasts, we're a bit more balanced on that front, and the propensity to surprise is probably on the upside for European growth and on the downside for US growth. That's not to say that we expect European growth to be stronger than the US. We're not saying that. But I just think that expectations are already very negative in Europe. They're already quite positive in the US in terms of the growth picture.
Yeah.
And so, as I say, the propensity to surprise is probably more positive on the European side. That will have an upward impact on European bond markets. We also saw that the ECB were reticent to pivot as the Fed did. And pricing for cuts for the ECB next year are very aggressive. I mean, over 150 basis points of cuts for 2024, which is similar to the Fed, obviously, but we're coming from a much lower starting point in Europe. So I wouldn't be surprised to see European bond markets generally underperform next year, and certainly within that we could see some spread widening in the peripheral sovereigns.
Rooting for the underdog, it seems to be the call for 2024. All right, so I'll wrap up our tour around the world, as we will. Let's talk about the UK here. Where do gilts fall in that equation?
Yeah, the UK is a very interesting one. I've been quite positive on gilts for some time, particularly at the front end and particularly in swap space, given the issuance at the longer end. And I think the real reason behind that is, number one, we've got a Bank of England who have been notoriously dovish even through this hiking cycle. We've seen their three elements that they're looking at: services inflation, wage growth, and the unemployment rate. Both moved more towards their target in the last few weeks. And even today, you mentioned it, we've seen that GDP was negative for Q3, and we're probably on the cusp of recession, if not in recession already. I think, taking a longer-term picture, actually in the UK, it's possible that the neutral rate's lower than pre-COVID, whereas elsewhere it might be slightly higher. And that, for me, is because of Brexit. And the potential growth rate is now lower because less labour force growth. And therefore, how restrictive monetary policy is right now is probably higher in the UK than elsewhere. So that impact will start to feed through. We've obviously seen quite an outperformance of gilts in the last few weeks, but I expect that to continue.
Quite the call for 2024, rooting for the underdog and rooting for gilts. I'm skeptical. We'll have you back in January to see if you still feel that way. Jamie Niven, Senior Fund Manager over at Cantor, and we thank you so much for your insights. Well, we had a tour around the world in the bond markets with Jamie there. Let's continue that story and go right back to Asia, because Ubisoft is leading a drop in European video game makers, but it's coming out of news from China. They tightened their gaming rules there. Earlier, Tencent leading an $80 billion sell-off in some of China's biggest online gaming firms. Joining us for more on this, Bloomberg, Sophia Horta Acosta. Sophia, can you walk us through some of these gaming curbs to begin with? I mean, China's been really tough on gaming for a very long time. What's new here?
That's exactly right. So what's new is essentially the curbs until now had focused on the usage among minors, among children, really trying to discourage what Beijing saw as excessive behavior among children. And these new rules seem to be all-encompassing, so not just for the younger players, and that's what's concerning investors. Also, the curbs are designed to actually put a cap on players' spending, online spending, and also the time that they spend playing these online games. But Kriti, the rules are both, vague, because we don't know what the specific cap on online spending is, and they're also all-encompassing. That's really what's disturbing the market today, and you're seeing that reaction in the stocks. It really, really reminds investors of 2 years ago when Beijing kind of overnight declared the entire online education industry as non-profit. And really, the concern is how far these new rules could go. We are seeing, though, on social media, on Chinese social media, gaming users are complaining because of the vagueness of this, and because Chinese games are known for these kind of snazzy designs where players can design their own avatars and spend a lot of money doing so, and that's the biggest revenue source of revenue for Tencent and its rivals, Kriti.
Well, at the same time, I think geopolitics might be playing a role as well. At least that was some of the pushback in the last iteration of these curbs that we got. Is it relevant now?
I mean, I think it is relevant when it comes to the story of investing in China. This is the timing of these curbs is especially pertinent, Kriti, because it's right before the holiday, right before markets close. It comes at the end of a very punishing year for Chinese investors and investors globally who were starting to really look at China again. And because of the geopolitics, because of the regulation, and because of the weakening economy, a lot of investment had actually fled Chinese markets, and it was starting to come back. And the thing is, when international investors look at China, one of the first stocks they look at is Tencent, is NetEase, and those double-digit declines today are really a reminder of the policy risk in China and the dangers of looking at this market. And after a few very tough years for China investors, things were looking slightly up for 2024 because Xi Jinping was rolling out the red carpet, for foreign investors was saying, you know, that China still wants foreign capital to come in, and there was a sense of a rapprochement, at least on the geopolitical front, when it comes to the U.S. Today, this is the bad news. It's really disheartening. That's what investors are telling me, that this news comes on the back of what's been a sense that perhaps China was turning the corner, you know, not so fast, really.
The repercussions here truly global, and you're already seeing that even amid very thin holiday volume. The big sell-offs on Tencent, the European gaming makers as well, and I imagine some of the U.S. ones as they will open for trading shortly. Bloomberg Sofia Horta-Acosta, we thank you so much for that crucial insight. And it turns out China driving even more of the narrative for the corporate story. Is China Nike's Achilles heel as well? We'll bring you the story next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Nike share slide deepening in the U.S. pre-market after a plunge in after-hours trading yesterday as well. You are seeing shares trade at about $120, well, it was $122, $109 a share at the moment. Shares down about 11% in the pre-market. It all comes as the company announced it's seeking up to get this $2 billion in cost savings, saying that the quarterly sales numbers in China fell short of expectations. For more on this, I'm joined now by Bloomberg's Tim Lowe, who, to great avail, also calls it Nike and not Nike. Tim, talk to us a little bit about this share move here and really what the outlook and what the story is when it comes to Nike. I think going into this, a lot of people thought it would be a positive story, not a negative one.
Yeah, it's kind of funny because on some metrics, they had not a bad quarter. They beat expectations on their earnings per share. They matched revenue. But of course, they cut their forecast for the next 6 months. And the biggest thing that people are focusing on is China and the Chinese consumer. On a call last night, the CFO mentioned that Europe is a bit of a challenge right now, but also China. And I think that really spooked investors because as recently as September, CEO John Donahoe had, voiced confidence and kind of a bullish take on where the Chinese consumer is going in the sporting goods sector. So kind of walking that back a little bit, spooking not just Nike investors, but, it reads across the sector, Foot Locker, Dick's, Adidas, as we say here in Germany, Puma. All these companies are getting hit right now, and it has a lot to do with people reevaluating where things are heading in China.
I've got to say, I just cringed when you said Adidas. It goes against every fiber of my being to call it that. But Tim, let's talk a little bit about the more positive news. You said there were pieces of it in the earnings story. Can you walk us through some of those pieces?
Yeah, sure. Well, depending on your viewpoint, if you're an investor, you might be happy about this new plan to save $2 billion over the next few years. If you're an employee of Nike, it might not be so nice because a lot of those cuts are going to come on the employee front. Nike talking about, removing some even middle management ranks, streamlining some of their vast offerings of footwear and apparel. As an effort to make some savings to bridge the gap until the global economy looks nicer. So that's one aspect. And that's coming from a company that's been pretty disciplined in their savings plans over the years. The second thing people are going to look at is inventory levels. This is a problem that's been affecting the industry in recent years. Just a massive pile of unsold goods. It's led to discounts. It hurts profitability. But yesterday, Nike pointed out that their inventory levels dropped 14% in the last 3 months. So their inventories are back at healthy levels. They did, of course, forecast that, we're going to have problems in the months ahead with the shipping problems in the Red Sea and whatnot. That's going to weigh on profitability. But those are, some, for investors that have been staring at inventory levels as one of the key metrics for over a year, that's a positive sign if that's what you're looking for.
Well, it's really interesting that we talk about these positive signs because to me, Nike is such a global bellwether. So you really see it have a little bit of global repercussions, I would argue, for the macro narrative as well. Bloomberg's Tim Lowe, we thank you so much for that update coming out of Nike and some of the other stocks around the world that are really getting impacted by that story. But like I said, Nike is a global bellwether. So in the commodity space is oil. And that's where I want to go next here, because if Nike is starting to talk about some perhaps weakness in their sales, do you see the same reflected in the oil story if at the end of the day we're talking about a weaker consumer? And I would argue, in theory, yes, but in actuality, no. Some of that is going to be the thin holiday volume. Some of that is going to be a variety of other factors. Right now, Brent crude trading at about an $80 a barrel handle. NYMEX at about 74. Notice the spread between the two. You are starting to see $5 to $6 between the two international benchmarks there, really speaking to the idea that geopolitical conflict is getting priced in to Brent. And that brings me to the other piece of the equation, which is where OPEC stands on all of this. Now, to me, this is the story of the last 24 hours because Angola, an OPEC plus member, is now actually pulling out of OPEC altogether. This chart that's in front of you is actually showing simply the fact that their output has fallen 40% from their peak in the last 10 years. Now, Angola is one of those African nations that have not been able to make their quotas in a very, very long time. So a lot of the market read-through is fairly minimal from this. But the question is, what kind of precedent does it actually set for some of the other OPEC members at a time when there is pushback within the cartel that suggests that maybe Saudi Arabia and its peers are keeping oil prices too high and therefore ceding a lot of the market share to U.S. shale producers. Nevertheless, this is the chart I hope you'll think of when you think about the news from the last 24 hours or so. Now, coming up on the program, UK Chancellor Jeremy Hunt on Britain in a post-Brexit market for financial services. We're going to bring you some of that interview next. Stick with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We passed the Financial Services and Markets Act. We are changing the rules for prospectuses and for all sorts of the rules around IPOs to make the London Stock Exchange more competitive. We've got the Mansion House reforms, which is going to unlock a lot of capital into growth businesses from pension funds. So we are really motoring in the UK. We're hungry to attract business all around the world. And this deal with Switzerland is just another step in that direction.
UK Chancellor Jeremy Hunt there speaking with Bloomberg. And I want to stick with the UK, though, because there's a few stories I want to put on your radar. Eurostar train services between London and the continent back open this morning. It comes after employees unexpectedly walked out yesterday, disrupting travel just ahead of the Christmas weekend. France's transport minister announcing last night that the closure had been lifted after calling the blockage, quote, unacceptable. But bad news for London commuters. Underground workers will go on a rolling strike in the new year. More than 90% of union members voted against a 5% pay increase offer. Now, staff in the engineering and control center departments are planning to walk out from January 5th to 12th of next year. Now, coming up after the break, we dive into the geopolitics. Yemen's Houthi rebels vow to target more ships in the Red Sea as the U.S. bolsters its presence. We have the latest there and what it means for your portfolio. Stick with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The UK economy unexpectedly shrinking in the third quarter, raising the possibility that Britain might already be in a recession. But retail sales grow by far more than expected in November. Over in Asia, Tencent sinks as China cracks down on online gaming yet again. Investors also caught off guard once again. Plus, in the corporate space, Nike stumbled as earnings miss estimates, sales falling in the current quarter as it warns of ongoing challenges in the key Chinese consumer market. Good morning and welcome to the Pulse. I'm Kriti Gupta in London. There's a lot to digest here, but a top story we're following very closely is over in the Czech Republic, which will now hold a day of mourning tomorrow after the worst shooting in the country's history. At least 15 people were killed after a student opened fire at Charles University yesterday. Police say, however, that there is no evidence that the shooter had links to international terrorism. The attacker was killed in the rampage. I'm going to bring you now more from the Middle East. The U.S. has signaled it could support a resolution at the United Nations Security Council that would increase aid flowing to Gaza. The Hamas-led health ministry says Gaza's death toll has now passed 20,000 people. And at the same time, shipping routes through the Red Sea continue to be impacted by Houthi rebel attacks. The Iran-backed group has been targeting ships in support of Hamas. I want to get a little bit more insight here. Bloomberg's Al Nightingale joins me this morning. Al, let's talk a little bit about time frame here. We're going from months to years, perhaps, in terms of finding some sort of resolution to the Israel-Hamas conflict in particular. Is it the same time frame for soothing some of these tensions in the Red Sea?
Well, I think that's a very difficult question to answer. There are different levels of time frame. The first time frame is getting a force of some kind in place to try and get the ships safe, and you know we're expecting that to come any day, or to have a clarity about the announcement of that, and then it has to get put in place. Then it has to secure the ships. Then the ships have to be comfortable with it. Where that leaves the bigger military question, and whether the Houthis will kind of be controlled, is a completely different one. And you know, I'm not qualified to answer that. But clearly, that's a much longer and more kind of enduring question that the industry is going to have to deal with.
Yeah, a really interesting dynamic there. And of course, as we speak, we're showing simply the graphic of how much more extra effort is going to take to reroute some of those ships around Africa. But I'm curious what that means in terms of sustainability of that kind of solution. Simply this idea that the rerouting from the Red Sea to around the Cape of Good Hope adds 40% in distance. In terms of things like wages, labor, even fuel, that's going to be increased following that route. How sustainable is that alternative solution?
I think what it does is tighten up lots of shipping markets. There is enough fuel in the world to power that. The crews, you know, they get paid what they get paid, and they will continue to be paid what they're paid. So, it will boost costs, and it will delay the delivery of goods and commodities and all of those things. So it can be sustained at the moment. If you have different, dynamics going on in various shipping markets, then, beyond the Red Sea, then things could get more serious and challenging. But I think especially for container shipping, which is where we've seen by far the biggest number of detours away from the Red Sea, it just so happens that industry had been struggling somewhat, and these detours actually just tighten up a market that had been, not looking in a great place.
Certainly something we're going to be watching very, very closely in terms of the global ramifications of that trade story. Bloomberg's Al Nightingale joining us this morning for that crucial context. We thank you so much. And I want to stick, at least to some extent, with Africa here. The World Bank says Africa has gone through a, quote, lost decade as debt payments and lack of access to capital take resources from education, health, and the environment. IMF data showing African nations' debt to GDP ratios have doubled since 2013. I want to bring in Bloomberg's Africa economist Yvonne Mahongo, joining us live from Johannesburg this morning. Yvonne, good morning. When we're talking about these countries being highly indebted, what does that actually look like?
So we've seen a rapid buildup of debt over the past 2 decades. In terms of what it means, we've seen, on average, a doubling of the debt to GDP ratio to over 60%. What it's meant more recently is that countries have been struggling to repay their debt. We've had 2 African countries default since the pandemic. That's Ghana and Zambia, and more recently, Ethiopia. Looking forward into 2024, we do have some significant Eurobond payments that are due. Kenya, in particular, is expected to pay or has a Eurobond of $2 billion that's due in June. So investors are watching to see if they'll be able to meet that debt payment. And part of the reason for the anxiety around Africa meeting its debt payments is because of the rapid buildup of debt, but also because refinancing has become a challenge. We haven't had a Eurobond issuance in 2 years. Given the high US interest rates. So African countries are struggling to refinance their debt, resulting in a lot of them going into debt distress.
Well, in terms of debt distress, I've been watching this very, very closely for a series of countries. I think you mentioned Ethiopia there as the kind of latest example of renegotiating some of the agreements. How long can this last, though? Put a time frame on it for us.
Well, the existing example is probably Zambia. It's the first country to go through the common framework. And as I mentioned, that they defaulted in late 2020, and we're 3 years down the line, and they're still going through those talks. So it can take several months and going to years, as we're seeing in the case of Zambia. Ghana is also going through its talks. Ethiopia is also part of the common framework, also having restructuring talks with its creditors. But as you've alluded to, it can take years. So the concern is that we are going to have a few countries go into the same position of trying to restructure their debt, which doesn't mean that in that time period they'll essentially be shut out of international capital markets in terms of raising financing. And that just adds to the funding squeeze that the continent is experiencing, which we are seeing reflected in our depreciating currencies.
A final question to you here on some of these inflationary pressures that we are seeing in the continent of Africa. Why is it such a struggle to bring down inflation there, whereas in perhaps more developed economies, you are seeing that deceleration really speed up?
The reason for that is our currencies. We've seen sharp depreciations of several currencies. The Nigerian naira has depreciated by 50% this year, Angolan kwanza by 40%, Kenyan shilling by 30%, and that's reflecting this funding squeeze. In this high US interest rate environment, African countries are struggling to raise dollar funding. And as a result, we've had tight foreign exchange liquidity, and currencies are having to adjust. And given our high import component in our CPI baskets, it is reflecting in inflation. Nigeria's inflation is sitting at around 25%, similar to Ghana. So as long as inflation remains high, it means interest rates will also remain exceptionally high in Africa, and that will delay any prospects of rate cuts.
Bloomberg's Africa economist Yvonne Mahungo in Johannesburg bringing us that crucial context of what's turning out to be a truly global dynamic story. We thank you so much. Coming up, we continue with another one of our top stories here. Chinese electric vehicle powerhouse BYD reached a deal to build a factory in Hungary. It's very first in Europe. We look at how China's own EV market is driving oil down the road. That's all coming up next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
BYD has picked Hungary as the European site for a multi-billion euro investment into a new EV factory. The Chinese car maker will manufacture batteries and electric cars at the new site in the south of the country. I want to bring in an expert here on the autos industry, Elizabeth Berman, live for us in Munich. Elizabeth, walk us through this choice here. BYD, of course, coming from the Chinese market, a leader in electrification, expanding in Europe. But one, why Europe? And second, why Hungary?
Yeah, I mean, like you were saying, BYD has really taken off in China. It's the auto sales leader there. And that's also kicked off a search for new markets where it can sell its very successful vehicles. The most obvious choice there is Europe, where China has been making a lot of inroads with EVs because it's one of the most lucrative markets they can access. And BYD's search for plants has been ongoing for a few months. And there were several countries in the running. We had reports from France, from Germany, and now the choice has fallen on Hungary. Hungary is, of course, a hotbed for EV making and also battery making. And there's also a really interesting political dimension here with Viktor Orban very much courting the likes of Xi Jinping to attract those sorts of investments.
Talk to us a little bit about some of how this shakes out with the rivals, Renault, VW, Stellantis. To what extent is this a threat to them?
Yeah, it's absolutely a threat. BYD is very active in the mass market end of things. In EVs, also plug-in hybrids they manufacture, and they will be targeting the same market segments as Renault, Stellantis, and Volkswagen. And at the Munich Car Show in September, BYD had a very large presence there, very impressive stand. And the models on show there, it was very clear when you inspected them that they were on par, at least from what you could see at that stand, with some of the offering here. At the same time, the Renaults of this world aren't asleep at the wheel, so to speak, and there are significant plans to bring out much more affordable models as of the early months of next year.
In terms of just the value of EVs here, I think there's been a little bit of a pullback when you look at some of the momentum that we saw specifically in Europe around EVs. I'm most notably thinking of Rishi Sunak kind of pulling away from the green agenda in the UK. It's not as economically feasible as it once was. Is that the crux of why EVs versus petrol and diesel cars may be losing some more value?
What I would say is that we're moving into a very decisive phase of the transition. People who are early adopters of technology, who are keen on owning a Tesla, they've probably purchased one by now. So now the question is, how do we get vehicles into the mass market where it'll really make a difference in terms of the decarbonization goals that the continent is pursuing? And at this time, you know, most models are more expensive comparatively. There's still poor infrastructure. And there are several other hurdles emerging now. We can see that the used EV market is struggling versus combustion cars. So all of these factors combined, also you mentioned the regulatory wobbles that we're getting, all of these factors combined will be spreading a degree of uncertainty for consumers.
Regulatory wobbles, beautifully put. Elizabeth Berman in Munich, we thank you so much for joining us this morning. I want to stick with that EV story that she was really building on and dive into today's Bloomberg Big Take. So looking into how China's green auto transition is pushing oil to the age of extinction. I want to bring in Bloomberg's Clara Ferreira Marquez joining us from Singapore. Now, Clara, a pleasure to have you on the program, and congratulations on this big take here. Bloomberg did an EV trip across China. What do you get out of that journey?
Well, the reason we did it is because when we were looking at the recovery from COVID, we were talking to people going back to China for the first time since the pandemic. One of the most consistent observations was the surge in EVs over the past 3 years, how frequent they had become in terms of sightings, how you could see the batteries being changed on the streets in China, and what that might be doing for oil. But we couldn't really gauge from the ground what that might look like outside the big cities, outside Shanghai, outside Beijing. And so this road trip was really about understanding the extent to which the EV boom is gaining traction outside the metropolis, far away from the coast and into some of the more sparsely populated rural parts of China. And look at the infrastructure, talking to consumers. And what we found is really that, you know, many times analysts have called the peak of oil in China, peak oil demand, and many times they've been wrong. But what we have found is really that it may be much closer than we have thought in the past.
Well, a lot of mixed opinions around whether that is actually going to kind of continue, the current trends that we are seeing. A lot of the words peak oil keeps coming up. Is that fair to say that peak oil is and has already been achieved? What do you think?
It's pretty hard to say. If you look back to 2017, even with this sort of enormous boom in EVs, I mean, remember, China has sold more EVs than any other country in the world, about half of the world's total. By 2026, it'll be half of the new additions to the fleet. But every time we've been wrong, every time the peak is pushed higher, the peak is pushed along. What we have seen, and what was really significant to us, was the extent to which consumers saw economic benefits, and they also saw preferences around style and design. So there was really a consumer preference for EVs in a way that perhaps isn't really seen to the same extent outside China. That really is accelerating the adoption, accelerating the turnover in the fleet. And so, yes, as a result of that, we do see a significant change. However, of course, there's a very big fleet in China. We will still see 11 million gasoline cars added to the fleet this year, and it does take a long time to turn that over. So even if we see a peak, perhaps it will take some time for that decline to happen.
It's certainly something we're watching very closely. Bloomberg's Clara Ferreira Marquez bringing us the content really behind the Bloomberg Big Take. You can find it on your Bloomberg terminal and of course on Bloomberg.com if you so desire. Very quickly, I want to bring you some attention here to the Swiss franc, because you are seeing it strengthen against the dollar to its highest levels since 2015. The reason I bring you this in particular is, one, 2015 was the last time you had the currency cap on the Swissy there, but also because this is the trade that a lot of people have been advocating for in terms of the shakeout from some of these rate decisions or potential rate decisions coming in the next year or so. One of the most kind of underappreciated trades has actually been the Swissy. The idea here simply being that the Swiss central bank not really marching to the same beat as the ECB, but at the same time is really dealing with a lot of the capital flows in terms of being a haven currency that the dollar and the Japanese yen do as well. So that's going to be a really interesting dynamic, some really interesting calls as well coming from the European banks around that. But for now, you are seeing some true dollar strength on against the Swissy when it, true dollar weakness from the Swissy, largest against since 2015. That's going to be something for your radar, something we'll monitor going into next year. In the meantime, I want to bring you some of the other major stories that we are watching from around the world. That's going to come up after this break. The past few years have been a roller coaster ride for the semiconductor sector. We focus on what 2024 looks like for the industry next. Stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This, at first glance, is just a smartphone. But once you know what's inside, it becomes clear it's so much more than that.
So what really changed everybody's view of this device was what was at the heart of it, the microprocessor that was designed and manufactured in China.
It's at the center of tensions between the world's two biggest economies. The phone made by Chinese tech giant Huawei represents a breakthrough by Beijing as it tries to escape Washington's controls on its access to technology and establish a self-sufficient chip industry. If those U.S. controls had been successful, then a smartphone as advanced as this simply should not be possible without importing key components.
China now is more capable than ever of building advanced technologies.
And it worried U.S. officials who are more concerned about advanced chips going into military equipment than smartphones. It left them wondering, how exactly did China do it?
Our team, they're looking at some of the biggest developments we've seen in the chip sector this year, but do we see the same in 2024? I want to bring in a true expert on this about kind of the opportunities for next year. Bloomberg's Mark Bergen joins me this morning. Mark, you are a veteran of the tech space here. Lived in San Francisco, now London. Talk to us a little bit about the highlights in AI and semiconductors this year.
Yeah, I think it's really fascinating, sort of going on like two competing strains. One, we have this just enormous demand from this explosion in generative AI. And clearly the biggest beneficiary is NVIDIA. But there are also a lot of venture-backed startups that are trying to compete with NVIDIA. And then you're seeing sort of established players like Intel and ARM and Qualcomm get in on this AI boom, being able to sell chips to power this advanced AI and software. The other side of that, as the video showed, is this increasing geopolitics involved with chips and blocking access to selling into China and potentially blocking even more of the supply chain coming from China. And I think that's just, we're going to see a lot more of that next year.
When you talk about next year, though, I think one of the concerns is how much of that momentum has actually been pulled forward into 2023, especially when it comes to the AI story. And then even when it comes to chips, the capacity building is a question of years from now. Do you start to see maybe a slowdown, a little bit of a gut check in 2024?
I think we'll have a gut check. It's certainly on how widely these AI tools are actually being used, right? This was the year when every company's talked about generative AI. In 2024 will actually be the year when we'll see how it's actually being incorporated and used, right? Whether it's the banks and healthcare and governments, these are large buyers of technology. If they're actually going to take the risk on some of this sort of new software and startups, and traditionally this sometimes takes years, and often they're not very quick at adapting, or if at all. At the same time, I think we're seeing a lot more interest in places like from the UAE and Saudi Arabia in building out their own sort of artificial intelligence companies and buying up chips themselves. So I think there's still going to be a lot of increased demand, not just from the corporate private side, but also from the public sector.
Yeah, it's a really interesting dynamic because, again, we're also going to talk about regulation in that fold as well. Bloomberg's Mark Bergen, we have to leave it there, but really interesting conversation. We thank you so much for joining us this morning. There's a lot going on in terms of the monetary policy, in terms of trends that we see in 2023. A lot is going to change in 2024, and we will have plenty of time to digest that. But very quickly, I want to say on behalf of all Bloomberg Television, of course, Francine Lockwood, the namesake of the show, and myself, we wish you all a very happy holiday season, a very happy new year as well. Now, I'm saying goodbye from the Pulse, but I will be back in just a few moments with Bloomberg Brief, so it's not quite goodbye yet, but we're going to be talking about a lot of the same dynamics here. What does 2024 actually look like with a little bit more of an American lens on it, especially when we're seeing some pretty big market moves amid some very thin holiday trading volume? As those corporate stories we're hitting next, it is something you do not want to miss. Stick with us. This is Bloomberg.
geopolitics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it. Fellow
governors. Bad mood about being conservative? Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Lyons.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Good morning from our studios in London. I'm Kriti Gupta, stepping in from Danny Berger and Mandis Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Nike sinking as sales stumble. The company warning of ongoing challenges in the key Chinese market. And sticking with that story, they're doing a little more damage, cracking down on online gaming, catching investors off guard, and wiping billions from Tencent. Meanwhile, crude climbing, oil set for a weekly gain as shippers avoid the Red Sea amid attacks and Angola quitting OPEC Plus. A lot to dive in there, but first let's get a quick check on these markets because, of course, it is thin holiday trading volume, and you are still seeing red across the screen right here in Europe. Stock 600 down, well, virtually unchanged, but it was down more significantly earlier in the session. But futures on the other side of the Atlantic, they are down noticeably. Real underperformance coming from NASDAQ 100 futures down about 0.3%. Go cross asset, though, a little bit of a different story. The 10-year yield is really interesting because it's staying sustainably before that 4% level. 385 down about 2 basis points. So perhaps one might argue a little bit of a bid into the bond market. But again, amid these thin volumes, I wouldn't read too much into it. You are also seeing euro dollar hovering around 110. Now, virtually unchanged on today's session, but that's going to be a big theme going into January. How much of that dollar weakness story creates dislocations in the FX market for the rest of the world, and Brent crude as well. Again, dislocation seems to be the theme. Higher by 0.8% right now, trading on $80 a barrel, despite some geopolitical headlines that really, in theory, should be creating a little bit more volatility, and yet we are simply not there. That is your market picture, but let's get to the core of it and talk about the economics behind it. Joining me now this morning, Callum Pickering, senior economist over at Berenberg. Callum, there's a lot to digest. We've got a full feast of topics, if we will, but let's start with 2024. What is top of mind for you? And I'll give you a few options here, A, B, C, and D. Geopolitical tensions, of course, top of mind. Monetary policy, the U.S. election, and, of course, the deficit issues that you were seeing, not just in the United States, but arguably right here in Europe as well. What's top of mind?
Monetary policy and the U.S. deficit.
Okay.
First, monetary policy.
You got to pick one, Callum. Come on.
No. Well, monetary policy will be the central theme, but the U.S. deficit's the big tail risk, in my view. if for whatever reason bond markets decide they no longer want to fund the, what is it now, a 7% deficit in perpetuity, then the US is going to have a problem, the rest of the world is going to have a problem. Arguably, the main reason why the US has avoided a recession so far is because there's this persistent stimulus coming through on fiscal policy. But central banks will be the main theme. What we've learned over the last month is actually markets set interest rates, not central banks. And so let's see what happens in 2024.
I am so glad you said that. I've been saying that for a while, and no one seems to agree with me because simply, if you look at I'm going to nerd out for a second. The positioning on the markets, $5.3 trillion of money market funds, having a more real read-through, moving the 2-year than monetary policy ever did. Calvin, you made me very happy this morning, but I want to go back to the fiscal deficit question in particular. One thing that Moody's had really talked about when they issued that warning on the fiscal deficit was that strength in the United States is really a function of historical strength in the United States. So if you're talking about bond market investors not wanting to, I think you used the word fund in perpetuity, the deficit, where else do they go?
It's a good question. I mean, for me, there's no issue around long-run U.S. debt sustainability. U.S. is reserve currency as far as the eye can see. These kind of weird discussions, I don't put any weight on them whatsoever. The question is whether or not this strong U.S. economy this year, which was a bit of a surprise, keeps the labor market tight in a world of still supply-side problems. The bond market says, well, for now, actually, we've been happy. A lot of the spending has been on the supply side. It's boosting U.S. long-run potential. But if the U.S. remains strong into 2024, and the bond market starts to think that the fiscal deficit is adding to inflation pressures, and so the money that they've loaned to the US government is not going to come back with the same value, then you might see some marginal sellers. And then it's for the US government to signal that actually the dollar will maintain its value. The way to do that is through raising taxes or signaling a plan to bring down the deficit. So for me, it's an inflation risk that may reappear next year, that may force the bond market to just pull back a little bit.
An inflation risk tied to the fiscal deficit. There's quite a few domino effects there as well. But when you talk then about perhaps some of the pushback you're going to get from the United States, again, I'm kind of come back to this idea that there is still a historical norm here that's working against what traditionally would be logic that works in Europe and Australia and Japan, arguably around the world. Is there kind of a little bit of leeway for the Federal Reserve then, and I would argue the Treasury as well, in terms of issuance and this deficit? Is this really the moment where the clock runs out?
Let's see. The U.S. deservedly gets away with a lot of fiscal nonsense. The dollar is the reserve currency. Yeah. These are the deepest, most liquid markets in the world. The U.S. economy is still by far the strongest economy in the world. Yeah. It's the strongest advanced economy. It has the highest potential growth. And so it's obvious where you would want to put your money in an uncertain world. But heading into 2024, if U.S. growth momentum starts to pick up, if we start to see pockets of growth outside of the U.S., if the U.S. economy remains strong, markets may say, well, actually, the fiscal risks in the U.S. the fiscal and inflation risks are there. Let's take a little bit of money out. Let's take on some risk elsewhere where growth is returning. And then you'll start to see a rebalancing where the U.S. loses some of the privilege that it deservedly has, but maybe is in excess. And some of the pessimism, which maybe is unjustified elsewhere, starts to move up. That would be higher bond yields for the U.S., slight dollar weakness, and stronger growth elsewhere.
But where does issuance then fall into the dynamic you just laid out as well? And I'll kind of put a little bit of context on this. In the last 2 hours or so, we got some headlines coming out of Japan, specifically, of all places, talking about really pulling back on some of their debt sales by 10% for their fiscal 2024. You didn't see much of a market reaction on it as well, but they're dealing with a very different monetary policy regime than the United States and the ECB is. But it really harps on this theme of issuance, specifically to fund some of these fiscal debts. The EU did it as well this week in terms of adjusting their own rules when it comes to some of the way budgets in the European Union work. If the United States has to follow those same rules or that same sort of level of austerity that you're seeing in Japan and Europe, is there then creating some sort of liquidity problem? Is that what 2024 holds for us?
No, it depends for what reason bond yields are high. I mean, go back to the original point. Markets set interest rates, not central banks. But interest rates are just prices. Yeah. Right? What are the interest rates at the long end telling us? They're telling us that markets expect a world of higher nominal GDP growth. If that's the case, if those expectations are realized, we don't need such high deficits. what's changed in the world? This year was the first post-COVID year. What we saw with COVID is the end of the sleepy, sclerotic, post-Lehman economy with low inflation, low risk-taking, workers not pushing their wage advantage, firms not pushing their price advantage. We locked everyone down. We shut down part of the economy, we juiced it with monetary policy and fiscal, and when we reopened, we unleashed an almighty amount of economic energy, and now the economy is alive again. We've got nominal GDP growth, we've got risk-taking. Central banks and governments can step back in this environment. They don't need to add fuel to this fire. This is an economy now which is essentially woken up out of its slumber, and it's happened to such an extent that even Japan is getting involved. I'm much more afraid of central banks going too far and putting these economies back to sleep, which I think would be a disaster, than I am inflation being a little bit higher than it ought to be next year. I'll take the inflation over going back to the sleepy post-Lehman world.
So an insurance cut then is fully justified in your view?
I think an insurance cut next year, probably from spring onwards from the Bank of England and the Fed, is justified. I don't see the logic so far in the Fed validating market expectations for a cut when inflation still is well above target. Markets are heading that way anyway. Why does the Fed need to front run the market?
But why does that logic not apply to the ECB? You notably left that out.
Well, you could say slightly cynically that the German wing of the ECB still takes the 2% target seriously and probably wishes inflation were targeted below 2%. The ECB has a symmetrical target in theory, but there's still a bit of a downward bias. Also, keep in mind the ECB just hasn't tightened as much as in the Bank of England's case and the Fed's case, so arguably doesn't need to cut quite so much.
A really interesting dynamic. I wish we had a podcast here to stick you on. Bloomberg's Callum Pickering. We have to leave it there. We thank you so much for your analysis this morning. I want to get to some of the other top stories trending on the terminal. Latest data showing banks borrowed a record amount from the Fed's newest backstop facility this week. Increasing rate cut bets made borrowing from the Bank Term Funding Program all the more attractive. An all-time high of $131 billion was borrowed. Elon Musk is lashing out at the state of U.S. financial markets in a wide-ranging talk with ARC's Cathie Wood. Musk bemoaned the high regulatory burden faced by publicly traded companies, the pressure from shareholders, the limits of efficiency, and how passive investing is stoking volatility. Some strong words there coming from one of the largest publicly traded companies in the United States. Apple, in the meantime, has stopped selling the Series 9 and Ultra 2 watches in the United States on its online store. It comes just days before a ban related to a patent dispute takes effect. The tech giant will also no longer be able to repair watch models that are out of warranty, a potential headache for consumers. Now, coming up on the program, another major corporate story. Nike warning of weaker sales. We're going to discuss those disappointing results next. Stick with us. Later in the hour as well, we're going to speak to Leo Mariani of Roth MKM on the global oil market. Now stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Kriti Gupta, stepping in for Danny Berger and Manus Cranny. To one of our top stories here, shares of Nike sinking in pre-market trading. It all comes after the firm updated its guidance for the second half of its fiscal year. The CFO saying, quote, this new outlook reflects increased macro headwinds, particularly in Greater China and the EMEA region. Joining us now, Bloomberg's Joe Easton, all over this story. Joe, you were here literally 24 hours ago. We were talking about how great these Nike results were expected to be. What happened?
Yeah, well, I was completely wrong, as has been the case. It hasn't been the first time. So basically, all regions were worse than expected. The focus is on China, where growth in the sales was around 8%. That's less than expected. But also, they flagged EMEA as particularly weak as well. So that was down around 3% in the last quarter and predicted to weaken again in the following quarter as well. So all regions were bad. In America, it looked like people were reluctant to spend, apart from the two big events, back to school and Black Friday. Outside of those, they didn't really want to buy any running clothes or any other sporting goods. So it's negative across the board. The reaction's been pretty significant.
Which comes in quite stark contrast to what you hear on a macroeconomic front, right? That Americans are still buying, even Chinese consumers are still getting a little bit stronger. And then you get something like Nike. Was there any good news in this report?
Yeah, so the earnings, so the profit was actually pretty solid, which suggests they are cutting costs already. They've announced they're going to do $2 billion in cost savings over 3 years. That's, I presume you're still hearing me. Okay, sorry, a bit of interference. But yeah, so they're going to do $2 billion over 3 years, and it sounds like a lot of money, but in comparison with the fact they had $7 billion in costs in the last quarter alone, it's not a huge amount, but it is a positive. They managed to reduce wage costs and also freight costs as well. So there are positives, but you're not really seeing it in the stock reaction this morning.
I was going to say, when you're talking about efficiency, it usually boosts the stock, and it's doing quite the exact opposite here. Nike shares down 11.5%, and that's just in pre-market trading at about $108 a share. Bloomberg's Joe Easton, we thank you so much for bringing us that crucial context this morning. And at the core of the Nike story is, of course, the China story. You just laid it out there. Well, Chinese investors, and I would say global investors, getting caught off guard yet again. This comes after the country unveiled its latest curbs to crack down on the gaming industry. Joining us now, Bloomberg's Tom McKenzie here. Tom, these changes were fairly random. Where did they come from?
Yeah, well, you say off guard, and that's absolutely exactly what happened. So out of the blue, really, for investors, and you're seeing the reaction to that. About $80 billion wiped off the market caps of some of the biggest players. Tencent front and center. That company, just a few years ago, was almost at $1 trillion market cap. Absolutely huge in terms of the gaming space, but with investments, global investments as well. NetEase also being punished on the back of this. The rule changes are, it seemed, aimed at trying to reduce the amount of money that is spent on these platforms, on their games, because there's a lot of in-game incentives, and the amount of time that people spend on these games. There's some very real social reasons why China's policymakers might want to see this. There is a very real problem around game addiction in China. The problem, of course, from investors is that there was no warning of this. These are draft rules. They may be tweaked, but there's a lot of lack of clarity around what the rules actually entail and whether indeed this is the first shot across the bow after this previous crackdown about two and a half years ago or so. Are we back to a stage where absolutely we need to be on alert again within this tech sector to see if more rules are coming down the pike?
And how does that affect the global players that are trying to access that Chinese market that seems even harder to do now? Talk to us then about the broader tech space here. We're talking about billions wiped off of Tencent, and you look at the market, the stock market broadly. Is this kind of capping any sort of gains going into the new year?
Well, look, Kriti, you know this better than most, that Chinese shares have underperformed this year by a significant margin. At the beginning of this year, almost consensus call was lean into the China stock story because the reopening surge is going to be there. You want to get exposure. That didn't, of course, come to play. It's not just a result of the regulatory crackdown on technology, of course, but that was one key factor. It was the real estate crisis as well. But the hope was that regulators were going to ease off on these kind of crackdowns, at least give more forewarning that implementation would involve more coordination, cooperation. That is not what's happening. So it just reminds investors that that real lack of transparency is still there. That uncertainty is still there because there's this disconnect across government ministries in terms of the rhetoric and in terms of the rules that are coming through. On one point, you're seeing Xi Jinping going to an e-gaming event. On the other, you're seeing these kind of rules being pushed out. So it's that disconnect in the rhetoric and in the policy making that is keeping investors on edge.
Some might argue that clarity and transparency is really what we need from China, although that feels repetitive. Tom McKenzie, we thank you so much. We really, really appreciate, of course, that context. And of course, it's coming at a time when it feels like on so many fronts, Chinese news and the Chinese consumer is having ripple effects across what's supposed to be a very quiet trading period, from the gaming story to the Nike story as well. Well, let me add a few more things on your radar that are actually moving, and that is the currency story. When you look at Bloomberg's dollar index here, you are seeing fairly broad weakness. It's creating a tailwind into the euro. It's creating a tailwind into sterling as well. 110 on euro-dollar cable at 127. Dollar Swissy, though, interesting. Weird weakness that you were seeing the most since 2015 when Switzerland actually removed its currency caps. That's going to be something we watch very, very closely. More analysis ahead. Stick with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Brief. I'm Kriti Gupta, stepping in for Danny Berger and Manus Cranny. Stock futures falling as investors await the latest read on U.S. inflation for any hint on the Federal Reserve's rate path moving forward. Former Dallas Fed President Robert Kaplan saying we need to see more data, but take a listen to what he had to say.
The Fed is going to need to see
at least 2 or 3 months more of continued improvement. I think tomorrow will probably be good news, but they're going to need to see sustained improvement before they're going to be willing to take more action. And so I think the market should expect that it's going to take a while and more sustained improvement before the Fed does something.
As you say, they're not in the business of predicting business, they're in the business of risk management, right?
That's right.
And the sort of confluence of risks is pretty difficult to navigate going into next year. There's still a lot of upside risk in terms of stickiness of inflationary factors, services, as you point out, and quite a bit of confusion in energy prices right now too.
There's a tug of war between the Fed is very restrictive, but on the other hand, fiscal policy and this project spending is very accommodative. It's white hot. And so there's a bit of a conflict there. And so they're going to be watching to see whether the service sector inflation settles down somewhat. They're going to be hoping that the price of oil continues to be muted. But I would also, if I were there, be very aware that fiscal spending in this kind of strength means I want to see more sustained improvement, because the last thing you want to do is start taking action to cut rates and then see inflation start to back up. That's a scenario they've got to avoid, and that's why I say they're in the risk management business. They don't have to predict the future accurately, but they've got to manage the risk, and that means being very deliberate in here. And that's the reason you've seen the walk back.
How big of a risk is it that we continue to see financial conditions loosening, especially after the FOMC?
I mean, I think that's a significant possibility in that there's so much money in short-dated paper in bills that has to find a place to go and does not want to be left on the sideline when rates start to move down. So you're seeing this. There's a rush to either take duration or buy other financial assets, and that's what we've seen over the last week or so. I think the Fed just has to be aware of that. It can't do anything about that phenomenon. It's got to do its job, which is manage the risk and take its time and be deliberate. But I think you'll see the story of 2024 will be the Fed will be more balanced in terms of two-sided risk. They'll be aware that they want to manage inflation, but they're also going to be sensitive to the path of the economy. I think the level of fiscal spending being so significant will, I think, should be a big factor and allow them to be a little bit more prioritizing inflation over a slowing in the economy.
Expand on that, because there's really a lot of Treasury volume that needs to be digested in the next few years, right?
Yes, and I think this is a big concern. The good news is we saw Treasury yields back up over the last 3 to 4 months. We've now seen them come back into the high 380s. We've got $9 trillion of Treasury securities to sell in 2024. 7 of it is refinancing. Another $2 trillion is to finance the deficit we just ran, and it's going to get financed at about 200 basis points higher than the Treasury yields of what's rolling off. And so what the danger is, we keep building interest expense into the budget from $625 billion this year to $800 billion on its way to $1 trillion. And it's starting, if that continued, it would squeeze out not only discretionary spending, but some mandatory spending.
Former Dallas Fed President Robert Kaplan, they're speaking to Bloomberg. More on the oil markets next, the inflationary dynamic there. Stick with us. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? Welcome back to Bloomberg Brief from London. I'm Kriti Gupta, stepping in for Danny Berger and Manus Cranny. Here is what you need to know. Nike sinking as sales stumble, the company warning of ongoing challenges in the key Chinese market. And sticking with China, they are cracking down on online gaming, catching investors off guard and wiping billions from Tencent and other game makers around the world. Meanwhile, crude climbing, oil set for a weekly gain as shippers avoid the Red Sea amid attacks, and Angola quits the OPEC cartel. But first, let's get a quick check on the markets here, because, of course, there's thin holiday trading volume, and yet you are still seeing red across your screen. There is a sell-off afloat, but a marginal one. Stock 600 virtually unchanged today, although you did see a bigger sell-off earlier in the session. And what you are seeing in the futures trading across the Atlantic, a little bit more red on the screen. S&P futures at 47.91. They're down about 0.1%. NASDAQ 100 futures down as well, 0.2%, perhaps pulling back on some of the bottom feeding that we got yesterday, but certainly not seeing the Santa rally that I think a lot of people expected. I want to go cross asset here and take a quick look at the bond market. When you're looking at the 10-year yield, it is sustainably below 4%. The bond market is actually catching a bid, 385. This is where you see some green on the screen, where you do see yields drop by about 2 basis points. Euro-dollar even stronger, 110, as we continue to see dollar weakness across the board. And that dollar weakness creating a little bit of a tailwind for Brent crude as well. 79 handled, just shy of the $80 a barrel level for Brent crude, higher by about 0.5%. And that's where I want to go next. The oil story is so fascinating to me because on the one hand, we're talking a lot about the macroeconomic factors, demand, supply, the Red Sea tensions as well. But in the last 24 hours, Angola, one of the OPEC nations, has actually decided to quit the cartel altogether. Now, this chart on your screen right here shows you what Angola's output looks like. And really what you need to know is that it's fallen 40% from its peak. It basically means this is one of those African nations that hasn't been able to meet a lot of the OPEC plus quotas. And therefore, a lot of the analysts might say that there isn't going to be that big of a read-through from them leaving the OPEC cartel altogether because, frankly, they weren't contributing that much to begin with. But I want to get a little bit more of some expert analysis here. Leo Mariani, Senior Research Analyst at Roth MKM, a fellow Texan, joins me this morning. Leo, pleasure to have you on the program. We'll start with the Angola story. There's so many people saying this has no read-through into the oil markets. You actually saw that in the reaction, as in there wasn't one. But talk to us a little bit about the OPEC dynamics that we should be watching more broadly. What kind of precedent might Angola set for OPEC in 2024?
Yeah, so look, I think the issue with Angola has been brewing for quite some time. On the last, full set of meetings on November 30th, country came out and expressed quite a bit of displeasure with its production quota allocation for 2024. They were allocated 1.11 million barrels a day for next year. And immediately, really after the meetings, they came out and they said they intended to produce a little bit more at 1.18 million barrels a day. So the difference there is 70,000 barrels a day. We're talking de minimis. And based on your graph that you put on the screen there on Bloomberg, they're actually producing a little bit under that as of the latest data. So look, I think ultimately there's not going to be much of an impact on actual production, but it does show that there is some disunity within the group. And obviously, if you look at the last OPEC meetings, they were rescheduled in November by several days because they really couldn't agree on all the specifics rolling into 2024. I think the key thing to look out for next year, which oil markets are going to be watching closely, is that on November 30th, the group announced that they were going to increase cuts, but those cuts were only going to extend through the end of the first quarter, or March 31st of next year. I think markets certainly believe that they have to extend those cuts throughout the first half of next year, meaning till the end of June. So I think the next move by OPEC is to extend those cuts an additional 3 months or perhaps longer, and that's probably the key thing to watch as we get into early 2024.
Talk to us then about the dynamics in 2024 itself here. We're also dealing with the background of a lot of the geopolitical tensions when it comes to the Red Sea in particular, where, of course, is a major pathway for crude. If you look at some of the tanker rates, they are actually elevated. Talk to us about time frame here. So far, it doesn't seem to be making much of a dent in oil prices. But, Leo, do you think it will at some point?
I mean, look, I think oil prices are up a handful of dollars this week, like you said, not very significant, but I think there's certainly risk that we could move higher. And what we need to probably see is further escalation of conflict in the Red Sea, which certainly can raise the geopolitical risk premium that traders are willing to impute in terms of dollars per barrel into the crude price here. I think for oil prices to really go materially higher as a result of the situation in the Red Sea, we're going to need to see an escalating conflict between U.S. And its allies in the Houthi rebels. So obviously the situation there with war between Israel and Hamas, you can argue that this is sort of spreading over to Yemen. You're seeing it spread a little bit to Lebanon in the past several weeks as well. So if this situation continues to kind of spread around the Mideast, then I would expect a handful of more dollars to be added in terms of the risk premium to oil prices. So certainly I think the risk is probably to the upside if the situation escalates for sure.
But, Leo, you said if the situation escalates, if the United States gets more involved, isn't that exactly what's happening here? I mean, yes, there is some hesitation in terms of direct conflict, but in terms of international waters, there's already this major alliance task force being sent there. So why is that risk factor not already baked into the markets?
So, look, I think there are a few dollars for sure per barrel priced in, right? But at this point, we have yet to see U.S. warships sort of fire on inland Yemen. We haven't seen any direct confrontation with vessels that has escalated in a very material way, right? You haven't seen, for example, some type of, Houthi rebel vessels, being blown up or hit directly with missiles. So there certainly is room for this to escalate more. It was reported in the last couple of days that there actually is a plan of attack that the U.S. is working on behind the scenes to further attack, Houthi rebels on Yemen shores. So hasn't happened yet. Those are plans, is my understanding. Will that go forward? I don't know, but there's certainly potential for escalating military conflict over the weeks to come here. And I think that would certainly raise oil prices further if that happens. But yes, to your point, I do think that there are several dollars, 2, 3, 4, whatever. It's hard to estimate exactly dollars per barrel that already been attributed to the oil price here.
All right, Leo, stick with me because I want to bring our global audience a chart here, specifically when we're talking about what those extra barrels actually look like in terms of that geopolitical pricing, because I think something that on the surface isn't really showing up is showing up in terms of the spread between Brent crude and NYMEX, where you're actually seeing that rise a little bit. I think it's about a $5.50 or so spread between the two international benchmarks at a time when U.S. shale production is actually larger than what you're seeing in, I believe, Saudi Arabia and Russia historically. Leo, talk to us about this spread here, because back in my days of covering oil, that spread was only supposed to be somewhere between $3 or $4, and now it's creeping up to almost $6. Your take on the spread?
Yeah, so look, I think historically when you look at the spread between the two, like you said, it's been roughly $4 plus or minus over the last handful of years. And That's historically supposed to represent, sort of the shipping cost to get WTI crude to international markets in Europe and Asia. As you pointed out earlier, we have seen those shipping costs increase over the last handful of weeks as shippers have directly raised rates. Insurance rates to move barrels have also climbed. That gets imputed into the shipping costs. So there's no doubt that, part of the increase in the spread here has been directly due to those higher shipping costs over the last, week or so. And then you would also argue that, supply disruption to Brent barrels versus WTI barrels, that's really where you've seen the escalation, is the potential for disruption is more on those international barrels and not necessarily on the U.S. barrels as a result of the escalating conflict with the Houthis.
We've been talking a lot about the upside risk there. Let's talk about the downside risk, Leo. When we talk about simply the macroeconomic environment of an economy slowing down, but also this record shale production, is there a floor in prices that you have your eye on?
Yeah, look, always hard to kind of predict any type of absolute floor or anything like that. Oil's anything but predictable, as we've learned over the last, handful of years through COVID, with oil prices briefly going negative in the spring of 2020. But look, from my perspective, I think you're probably looking at something in that kind of $70 per barrel range for WTI. I think is probably a reasonable near-term floor if we do see deteriorating global economic conditions over the next handful of months, which certainly some folks are predicting. At the end of the day, it certainly stands to reason that higher rates, interest rates that is, around the world globally will continue to eat away at the consumer and is likely to impact oil demand for sure next year. Most of the major forecasting agencies are expecting a lower rate of demand growth next year. Demand is still expected to grow in 2024, but not nearly as robust of a rate as you saw here in 2023. So I certainly believe that's reasonable, and there will be an impact where we will see oil demand growth rates slow, but they will still be positive as global crude demand should climb next year.
All right, $70 is a floor in crude. Leo Mariani of Roth MKM, we thank you so much for your analysis this morning. Coming up on the program, we hear exclusively from the CEO of ARM on why AI is critical to their success. That coming up next. Stick with us. This is Bloomberg.
The reception, the acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg. This is Bloomberg Brief. I'm Kriti Gupta, stepping in for Danny Berger and Manus Cranny. Artificial intelligence has dominated the tech industry in 2023, with some related stocks posting triple-digit gains. We also saw a major debut in the space with ARM going public amid the AI fervor. Take a listen to Bloomberg's exclusive interview with CEO Renee Haas.
We've been public now for a few months. Yeah. So I would say I feel like the eyes are upon me a little bit more than they were prior. But on the other hand, I try to think about it in terms of the future of ARM is really not measured in what we are today. It's what we're going to be in a few years. I spend most of my time thinking about where ARM is going to be 3 years from now, 5 years from now. So on one level, yes, it's changed because the eyes are on us. We're a public company. We have to meet our expectations. We have to do exactly what we say we're going to do. But on the other hand, I'd like to think maybe not so much change because I'm thinking about 5 years away, just like I was before the IPO, same way I'm thinking about it today.
And how do you balance the demands of investors in the company now, those new investors, and the legacy investors, and of course, Masayoshi Son, SoftBank being the big force, gravitational force there? How do you balance those demands?
So ARM is really a company that is hard to look at quarter to quarter because the technology we're working on today is really technology that's going to end up in products 3 years from now, 4 years from now. So while the financial results are important, they're really the results of strategies we put in place a number of years ago, which were quite successful. This is when we created our Neoverse product line for the servers. We created our automotive product lines. And you're seeing those things really come to bear. So for us, what we try to do is just make sure that the investors understand that while the near-term results are very important, it's really also important to really think about the long term and where we're going directionally.
ARM was set up in the 1990s. You've been the building blocks of our digital globe, digital world, digital economy since then. And now we're at this point where we're focused on generative AI, and that is reshaping this digital ecosystem that we now live in, or that we will be living on. What role do you see ARM playing in that transformed digital space in the years ahead?
Yeah, so ARM in the 30-plus years has just been foundational to computing in a way that no other computer architecture before it, and I dare say after it, has been. 70% of the world's population touches ARM today in some way. We were well known for smartphones, and before that, non-smartphones, feature phones, if you will. The ARM of today is not only much more diversified around, as I mentioned before, data centers, automotive, IoT, but now as AI and AI workloads are finding their way into every single application, whether it's your thermostat or your data center, ARM will be there. So I think for us in the upcoming years and decades, ARM will be foundational to everything going on with AI.
So you can assure investors that you will remain, you're essential right now to this digital world that we live in. You will be essential in that generative AI reshaped world in the years ahead. You will continue to play that essential role.
You can't run AI without ARM. It's foundational. And AI is going to find its way into every single electronics device that we use. Again, whether it's the smallest device in your home or the largest data center that sits out in the wild.
Every AI executive that I speak to, whether it's DeepMind or Cohere or Inflection or others, say the scramble for compute is front and center, along with the fight for talent. How do you see that fight for compute going forward?
I do think for the next number of years, we are going to see a increasing demand for more and more compute. Now, I think that's also going to drive is a high degree of need for power efficiency, because these data centers require hundreds of watts, megawatts, up to the gigawatts of type of energy. We don't produce that much energy as a planet. We are having limitations relative to fossil fuels, limitations to sustainable. So a rush to get to power efficiency around these compute models is going to be very, very significant. That's great for ARM because the DNA of our company is around power efficiency.
ARM CEO Renee Haas, they're speaking to Bloomberg's Tom McKenzie. But let's zoom out a little bit. Let's talk about the general state of tech going into next year. I want to bring in Bloomberg's Mark Bergen to give us a little bit more of a survey of this area. Mark, a pleasure to have you on the program. Let's talk about the progress that we've seen in 2023. How much of that is pulled forward from the next couple of years?
You know, it's something that Haas didn't mention, but it's certainly an elephant in the room, is that the foundational chip company in many ways for this AI moment and going forward is NVIDIA. They've had just tremendous gains, kind of driving the stock market this past year. You know, ARM is trying to elbow into this market around data centers, where we're seeing an expected just rise in demand around AI services and cloud services, but so is Intel. And so I think we're going to see this continued competition there. We're going to see continued constraints being placed by certainly in the U.S. and in other parts of Europe around selling into China and both ways of that supply chain.
But do you think in terms of a stock performance, you mentioned NVIDIA there, and we show those triple-digit gains there. It feels like it is the buzzword of not just 2023, but arguably 2024 as well. We just heard it with Micron getting this massive bid just by saying artificial intelligence. Is there enough capacity, enough kind of resources to actually fully move 2 feet forward into that?
Yeah, I mean, you know, it's pretty easy to draw comparisons to a few years ago when companies were just throwing blockchain or Web3 and then seeing immediate stock boom. And obviously that hasn't panned out. I mean, you know, you talk to everyone in tech and they'll consistently say, look, this is not crypto. This is not blockchain. There's something real and substantive here. And I think the argument there would be around the largest players in technology, at least the kind of big cloud companies. You've got Amazon, Microsoft, Google that have been investing billions of dollars into this, investing directly into startups, building out capacity, because they see, I think this is largely a cloud game. And this is a company, Oracle's been trying to get in for a while. We have Alibaba in China, but this is 3 companies that have been driving this market. And so they're building out capacity, and they have the balance sheets to do that. I think then, you know, what we're going to see next year really is whether or not this is being used. Are banks going to start using this? Are hospitals going to start using generative AI? Will this actually be something that goes from sort of a research and foundation and buzzword into practical applications? And I think we're just beginning to see that, but we're a long way from those practical applications actually translating to commercial uses.
Well, I think a big hurdle that's standing in that way is a general kind of scare factor around what that actually entails. I mean, you said this isn't crypto, but it kind of feels like that in terms of how much people actually understand it and, frankly, how much regulatory scrutiny it's getting. Notably, Elon Musk and Sam Altman have both warned against using AI. Do you think that is going to be a major hurdle going into next year, or are we kind of moving past it?
I think so. There's two different, those are sort of warnings from Elon and others is around the existential risk. And there was a summit here in the UK around that. Certainly those are going to be concerns on the, say, like bioweaponry, on the cyber attacks. I think the more tangible and immediate concerns for companies is going to be around just the regulatory and compliance risk, right? Like there's the concerns about some of these large language models fabricating facts, right? And if you're a law firm and you're using that, you do not want to fabricate facts. And so, and then there's a lot more uncertainty about the regulatory environment. I think once the EU has passed its AI Act, we'll have a lot more clarity. It'll sort of be a little bit like GDPR, where it's kind of it's been a pain for a lot of companies to comply, but at least there's certainty. There are a lot of tools and processes going forward. And so I think it's kind of, we're in a period of some of that anxiety is just waiting for the chips to fall on a regulation.
Bloomberg's Mark Bergen covering tech for us all morning long. We thank you so much and wish you a very happy holiday season going into the next couple of weeks. I want to get a quick check on the markets here and talk a little bit about the broader dynamic that we are seeing. Remember, underperformance in NASDAQ 100 futures, even though you are seeing S&P futures mostly down only 0.1%. Very thin holiday trading volume there, as it is in the bond market as well. The 10-year yield at 386, down 2 basis points. I would argue that's pushing the dollar a little bit weaker as well, creating about a tailwind to some of the European currencies around the world. Now, coming up, we'll look at some of the market-moving events to watch throughout the day. Stick with us. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
This is Bloomberg Brief. I'm Kriti Gupta, stepping in for Danny Berger and Manus Cranny. Now, look a quick what is ahead today. We're going to get the latest rate on U.S. inflation, plus personal income and spending data, all coming at about 8:30 a.m. Eastern, followed by new home sales and UMich consumer sentiment data coming up at about 10 a.m. New York time. Plus, the Treasury market does close early today at about 2 p.m. Eastern, ahead of the holiday weekend. That being said, there's still plenty of market reaction that we're getting, specifically on the micro front. And there's, of course, major corporate stories I want to bring to your attention. Nike taking a really big hit this morning, 108 a share. Shares down almost 12% in the pre-market. It comes after kind of a double whammy there. Of course, that cost efficiency story, $2 billion in savings coming out. That should, in theory, be a good thing, but it's that warning about weaker sales in China, a key growth area for Nike that's really weighing on those shares. They just don't know when they're actually going to recover, and especially in a macroeconomic environment, that is not the message investors want to hear. On the other hand, you have some of the gaming stocks taking a hit as well. EA, Take-Two as well. We're not throwing Activision on here because given they've had that buyout from Microsoft, but those two stocks down under pressure as well because China, it is ramping up its regulation when it specifically comes to some of these gaming companies. Remember, gaming addiction is a big deal in China, so they are really talking about just how much of kind of a win you actually want in that sector. So, of course, EA and Take-Two following the trend you are seeing from video game makers around the world. I'll leave you with those two thoughts, and in the meantime, as we wrap things up, that does it for Bloomberg Brief. I just want to wish you, on behalf of the Bloomberg Brief team and Bloomberg Television, happy holidays and, of course, a very happy new year. We really appreciate your viewership, and we wish you and your families a very happy holiday season. Stick with us. Surveillance is ahead. This is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to
Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
If the market goes too far on its own, then the question will be, what more does the Fed need to do?
The Fed is likely to cut next year, but every time the Fed announces cuts, the market doubles those cuts.
The reality is the Fed may get us to a hotter landing, but the markets have to adjust to that, and they haven't.
If the markets are rallying, that's okay with the Fed. The Fed doesn't have to push back on a rally because they don't like a rally.
I do think the Fed put us fairly back.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's beginning to look a lot like Christmas. Good morning. This is Bloomberg Surveillance from New York for audience worldwide. Good morning. Welcome back. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John off until the new year. Katie Greifeld, you are the lucky one who gets to do this with me, and I'm so pleased to say that you're here. Welcome. To me, honestly, growth concerns kind of creeping back in there very much as we head toward the holiday.
That might explain what we're seeing in the bond market. I was just fiddling around with some charts because the year-to-date chart looks a lot like the one-year chart. It's only like a week where we get to do that. 10-year Treasury yields are pretty much flat on the year, which is amazing.
Especially considering what people were looking for at the start of the year in terms of a recession and then some sort of recovery. We didn't get the recession. We got a recovery to no decline. Here's the issue. Nike comes out. They talk about job cuts. They talk about $400 to $450 million of charges in order to cost cut across the board. Other companies are falling in tandem. Is this just idiosyncratic to the retail sector, or does this extend further beyond?
I think if you ask equity bulls right now, they would say it's idiosyncratic, and you see that at the benchmark level. But I will say, to your point, I mean, we keep hearing and hearing and hearing this story from the retailers. You have to think that that means something when you add that all together. And China is, especially for Nike, really warning about those macro concerns. That's been an issue for Nike in particular all year, and it continues to be.
Well, this is the reason why it's sort of interesting that you point out that we're in the same place for the 10-year yield from the beginning of the year till now, with a very bumpy and not a straight line at all when it comes to stocks, which have gained tremendously. Are we setting up for something perfect that cannot happen? Are we looking for some kind of strength and disinflation that comes together with some sort of supply chain resolution that already happened? And that's why I think that today at 8:30, it's going to be really key, this key metric, whether it keeps coming in with that disinflationary kind of tendency, the way the Fed is hoping for.
This is the last day that matters. I think the year ends at 2 p.m. today.
Absolutely.
When the bond market closed, and it starts at 8:30 with those PCE numbers.
And that's the reason why we're looking to this. Yesterday did get a bit of a boost, and everyone was trying to explain why. One person pointed to the data that came out in the third revision of the third quarter GDP, which just shows you how much people are really reaching for things to sort of explain market movement, pointing to the fact that inflation was revised lower to 2% from 2.3%, highlighting that we're getting back to the Fed's goal much more quickly. So people view this as a bullish thing. Is it bullish, or does it signify a sort of Patrick Harker underlying weakness that's coming to the fore, the likes of Nike?
That's the thing. I mean, inflation, of course, has been falling quickly, much more quickly than the Fed originally expected. But is this a precursor to maybe growth actually faltering as well? You know, I know that the point has been made that a soft landing looks like a soft landing when it starts, but it also, a hard landing also looks like a soft landing when it starts.
We were all talking this week, and you and I have been talking about this for hours and hours a day, about how much everyone seems to be a buyer and everyone seems to be a bull. How surprised were you to see that equity funds had their biggest outflows since 2022, since December 2022, and that money piled into cash when everyone's talking about deploying cash? This according to the Bank of America EPFR data that came out overnight.
You know, I follow ETF flows in particular a lot, and it feels like, you know, typically you should see flows follow performance. That hasn't necessarily been the case this year, especially if you look at some of the bond funds in particular. And it feels like in equities too. I mean, of course, you take a look at the price action overall on the benchmark level, it says one thing, and then you see that check of investor sentiment when it comes to where money is actually moving around. So it seems like we got another reality check yesterday when you think about where people are actually putting their money.
Yeah, $21 billion outflows from equity funds. Just in terms of what we're looking for today, 8:30 a.m., we do get personal income, personal spending, and PCE, a core deflator. That is the key metric that the Fed is looking at. And typically, to understand the forward trajectory, it is expected to decline further from 3.4%. Is it enough? Does this confirm the disinflationary kind of Goldilocks that people are celebrating? Or does it start to signify maybe any kind of shift in the narrative? At 10 a.m., we get new home sales as well as University of Michigan sentiment survey. Very curious to see whether or not you get an uptick in the sentiment index, especially given what we saw in recent other surveys that came out. And it is a holiday day. I mean, it definitely feels like the last gasp before everyone goes on vacation. And I'm not just saying this because I'm going on vacation. Treasury markets are closing today at 2 p.m. And it is kind of a quiet morning, a little bit of softness. But if this is another gain on the week for the S&P, that makes 8 straight weeks of gains. That is the longest, going back more than to 2017.
It's pretty amazing. You think of all the capitulation we've seen as a result, especially from the sell side. I will say, to the early Treasury market close, why can't the equity market get on board? It feels like this always happens, that the bond market closes, but the equity market is on a little bit of a different schedule.
I think the bond market probably has it right. Yeah. You know, they've had enough pessimism.
They
for the
usually
year.
do, right?
And so, you know, I think everyone should just follow suit and just take the time off. Marvin Lowe, maybe doing the same. Senior global macro strategist at State Street, joining us now. Marvin, do you have an answer to that? Why the bond market tends to kind of beat to its own drum versus the stock market?
Well, I couldn't agree more with your assessment. So for sure, we should start our celebrations a little bit early if we can.
Meanwhile, we are talking about how treasuries are basically unchanged on the year with a very tumultuous path. Amazing. Do you think that stocks are getting the message that treasuries are sending right now?
You know what? You know, certainly there's reason to be optimistic within the risk assets. It's really just a matter of how aggressively things have moved, and you know, really the counterweights between looser financial conditions and you know, ultimately the package that the Fed is trying to deliver with regard to inflation, with regard to growth. And it does, to a certain degree, push back against it because financial conditions have loosened as aggressively as that 10-year yield has come down.
And Marvin, I want to talk a little bit more about what we're seeing in the Treasury market, particularly at the long end of the curve. Of course, Lisa brought up that you maybe are starting to see some growth fears seep in. And you think about this incredible move that we've seen in 10-year yields, in particular, since about mid-October or so. Is that growth fears? Is that maybe a FOMO grab when it comes to duration? How do you explain what's happening at the back end of the Treasury curve?
Yeah, I mean, for sure, if you will, you know, what we talk about is the left tail risk. You know, the risk that there's a significant sell-off, let's say in bonds or in stocks for that matter. And the Fed kind of took that off the table. You know, once they signaled that they were done with the hiking cycle, we don't have to worry about the left tail from that perspective anymore. So, you know, we're really trying to figure out how much of this we want to buy. I think the inconsistency is like to think about rate cuts that begin in 3 months. So, you know, within a quarter, the Fed is going to start to, at least from a market perspective, a Fed is expected to start cutting. In my mind, that only happens if really bad things happen in the economy. And I don't see that. It definitely is moving in the right direction. But in terms of, jobs cracking and inflation all of a sudden collapsing, it's not there in the data, despite the fact that the Fed is hinting that there are other things that they're looking at other than the data. And I'd like to know what that is, if in fact it's true.
And Marvin, to your point on the timing of rate cuts, I really like this line in the notes that you sent over, that the Fed cannot afford to cut and then need to hike again. Why is that?
Sure. I mean, the credibility of the Fed has been called into question all year. I mean, they've really moved with the tides as aggressively as you can. The worst environment in my mind is one where they say that they're signaling all clear, mission accomplished, and they cut. And those inflation fears in the middle of the year, whether it's because base effects start to wane and or the labor market remains stronger and therefore wages remain stronger, and they need to somehow put a more tightening message out there, then they lose control of all their forward guidance, which in a lot of ways that they are losing control of, given how aggressively this market has moved while they continue to push back on the move.
So you think the risk, Marvin, is of inflation overheating and actually reaccelerating rather than true weakness in the economy. Is that right?
As far as everything I see, that is a concern. And I think kind of this balance sheet discussion, which is starting to make its way into the foreground, is part of that. Not only is the QT process in play, if you will, but if the QT process stops early, let's say they coordinate the start of rate cuts with the stopping of QT with a massive balance sheet, I do think that you have reaccelerating inflation concerns just because the balance sheet is so big and just because all of those reserves, if you will, that are out there remain out there.
How have you changed your view since the Fed pivot, right? I mean, it seems like everybody is scrambling to reassess their baselines going into 2024. How much have you actually changed yours?
Yeah, I haven't that much. I've really used kind of this balance sheet discussion to help guide me in terms of the thought process with regard to what the Fed should be doing versus, what the data ultimately is saying. The Fed should be getting their financial balance sheet in order before really getting to this phase of cuts. We've got too much liquidity in the system, and there are economic and inflation implications associated with an ongoing large balance sheet, which I don't think anyone would, I don't think anyone on the FOMC would have thought that they would be considering stopping the balance sheet when it's still over $7 trillion.
Let's talk about how the Fed talks about the balance sheet, because, of course, the consensus seems to be that, okay, if they're cutting rates just to get out of very restrictive territory, maybe get back to neutral, that QT can continue on. If, of course, they're cutting because there's a recession, then that becomes a little bit more challenging. But assuming it's the first scenario where they're cutting basically to get back to neutral, how do they explain that to the American public? And do they need to, that they're continuing, of course, to run off the balance sheet in the background?
Yeah, they do need to explain it. It's incredibly complex if they're, on the one hand, loosening financial conditions by cutting rates while continuing to theoretically tighten. I'm not in the camp that they would go down that route. I know Chair Powell raised that prospect that normalization could continue. Normalization on the rate side of things would allow them to potentially continue the QT process. I think what we've seen over the course of the last 2 to 3 quarters is a Fed that's coming to the conclusion, just based on the number of, the many that say that you can do two things in opposite versus very few that think that now. I think that they're going to be linked at the hip ultimately.
So Marvin, just heading into 2024, what's your highest conviction trade?
Yeah, I mean, I think risk assets have moved too far. If I were to look at this, I would be concerned with valuations on the equity side of things. I do think that we've probably seen the best from a yield perspective for at least the next couple of quarters. And there's probably better lower yield type discussions that evolve outside of the U.S. Certainly we're seeing growth concerns pop up in Europe, and those cuts seem more justified than what we're looking at here.
Marvin Lowe of State Street, thank you so much for your insights, talking about some of the weakness and the cuts that might be justified in Europe. They're not necessarily saying that, and certainly you're seeing euro strength. Regardless of some of these expected cuts, you're also seeing Swiss strength. Did you see that the Swiss franc rose to its strongest versus the dollar going back to 2015, with people kind of gaming out, okay, well, maybe they'll actually enjoy a stronger currency to bring down inflation domestically.
What does the signal mean coming from the Swiss? Of course, we think about growth fears maybe getting priced into the Treasury market. When I think about really rapid Swissy strength, it seems concerning when you think about the haven aspects.
Especially given the fact that it's pretty much across the board, although it's not necessarily versus the euro right now. This is very much a dollar weakness story, as well as people game out whether the Fed really has pivoted and is going to cut rates. We shall see. Right now in markets, a bit of softness, although unclear. Can we eke out an 8th straight week of gains on the S&P, basically unchanged, down, a hair. And we're looking at euro strength crossing the 110 mark. Again, this is really interesting to see the dollar really on the back foot heading into 2024. 10-year yields hovering around that 3.86% level, and crude just bouncing around that same level of $75 to $74 a barrel on WTI. Coming up at 7 a.m., we get hear from Ed Yardeni of Yardeni Research. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's very important to understand that the Houthis aren't attacking just one country. They're really attacking the international community. They are attacking the economic well-being and prosperity of nations around the world. So in effect, they've really become bandits along the international highway that is the Red Sea. The Houthis need to stop these attacks. They need to stop them now.
That was Major General Pat Ryder, Department of Defense Press Secretary, addressing the Red Sea conflicts as a growing number of voices try to get some stability there. Insurance costs are rising for some of these container ships, and we are seeing a lot of shipping companies adjust their routes. Welcome back. This is Bloomberg Surveillance. Tom and John are both off today. I'm so pleased to say that Katie Greifeld here alongside me. We are seeing a bit of softness to end the week, although things can change, and it's basically unchanged. What we are looking at is yields materially lower over the past 2 months, kind of hovering around that 3.86%. And crude, really interesting to see that crude has hovered around $74 to $75 on the barrel on WTI, Katie, especially given the fact We've had all these disruptions. We've had record demand. We have had supply cuts from OPEC, and still we've seen that persistent sort of weakness over in the crude sector.
Yeah, I have to say crude is one of the more interesting, more confusing stories this year. It seems to all be predicated on supply. And of course, interesting, just yesterday, getting some OPEC drama with Angola leaving OPEC. I know we're going to get into that a little bit later. Excited for that one.
I am too, especially given the fact that a lot of this has the backdrop of the United States production, which has gone gangbusters, despite what the administration is deciding not to talk about. And I want to really dovetail that into industrial policy going into 2024. I'm so pleased to say Kim Wallace, head of Washington Policy Research at 22V Research, joining us here in studio for the holiday party, for the holiday spirit, for New York City. Thank you so much for being with us. We really appreciate it.
Good morning. Happy to be here.
Good morning. I know that you put out an outlook for what to expect in 2024, and I want to start in industrial policy, hinging off the latest news of U.S. Steel and some of the administration pushback to a Japanese conglomerate purchasing the largest steelmaker in the country.
Well, you know, there's a lot of analysis that will go into the ultimate reaction from the administration. Obviously, the Committee on Foreign Investment in the U.S. will investigate the proposed merger. But when you break it down, the promises made by Nippon probably upset a few people on the political side, but don't, in my view at least, imply disruption to the production of steel in the U.S. The deal proposes to combine globally number 4 and number 27. So the first question for the competition policy reviewers is it a global market you're defining when you review the deal, or the national market? My sense is it'll be a global market. And if that's the case, we look at Japan as a strategic partner. It's difficult to imagine that if Japan can't close a deal like this, that anyone can close a deal like this.
Do you think the Biden administration has been consistent with industrial policy? On one hand, talking about America first in some ways and talking about unionization, but not necessarily celebrating the fact that the United States is pumping a record amount of oil, which has really offset a lot of the prices and kept gasoline low.
I think they've been as consistent as you can be as a policymaker in this environment. A couple of points there. First, we have started from a very low point in industrial production and manufacturing. We gave away that base in the 90s and the first part of this century. Reclaiming it is going to take a long time. The report that the National Economic Council and the National Security Council put out in June of 2021 quantified how far back the U.S. is. The president then sought to make up a gap there. Congress joined them. This has been a bipartisan effort, particularly in infrastructure. So we are way behind the ball when it comes to, in the U.S., when it comes to infrastructure, when it comes to chips, semiconductors. We have a long way to go. Deals like this have to be reviewed from all of those perspectives we talked about, but ultimately, what's best for the U.S. in terms of short-term supplies and then longer-term building out of the industrial base. That's part of the president's proposal in the emergency supplemental. Almost $60 billion for a defense industrial base, $3 billion of that to build more submarines.
And you bring up chips, and that's where I want to go, because you think about the U.S.-China relationship, obviously still a lot of tensions there, a lot of that playing out in the semiconductor arena. But when you look over the totality of 2023, how has the U.S.-China relationship evolved?
It has stabilized, and the optics are better against a backdrop of severe competition. Competition across a lot of platforms, and that's not going to change. We see that almost daily. We saw it this week in critical minerals. And so when China decides that it's not going to allow the export of processing technology for critical minerals, that's a shot across the bow. It again points to a deficiency in the U.S. industrial base, and something that it's hard to make this political if you look at it from an economic standpoint. Of course, people will make it political, but making up for the deficiency will require decades, not just years.
Well, in the context of critical minerals and, of course, the news that we saw this week, both on that front and also that U.S. Steel Nippon deal, you talked about Japan as a strategic ally here. And when you think about the arena of critical minerals, and, of course, the competition going on there, how important does that make Japan and potentially other partners?
It's that last part, Katie, potentially other partners. Japan is critically important. There is no Indo-Pacific strategy, which is important to this administration, without Japan. And that goes back to my saying, if Japan can't close deals, then no one can. But it's the other players. What we saw at the beginning of the APEC week that didn't get a lot of attention was a national security partnership signed between Indonesia and the U.S. U.S. sends defense technology, defense know-how. Indonesia promises to send critical minerals eventually. It's part of a very sophisticated program. Sophistication is necessary given how far back the U.S. is, in my view.
Taking a step back, you've gotten plenty of accolades for your research and for your view forward, particularly when it comes to politics, which recently has been a black box of absolutely impenetrable predictions. But I'm wondering next year what you see as some of the bigger market-related risks stemming from Washington, D.C. at a time where there's a lot on the table, not just industrial policy.
I think there are big four. The first quarter will be consumed by fiscal policy. What does Washington do around funding for FY24, and what does it do about the supplemental requests around wars? I think that morphs into first, second quarter. What's the result of the Fed's business over the last 2 years? How does that play out in the economy? Normalization at this part of the cycle means tightening. Normalization soon will mean the other side. That leads into, in my view at least, concerns about liquidity, both official liquidity, private liquidity. It's the topic very few people want to address in public, but something that pops up on a regular basis as a concern among traders all the time, both official and private liquidity. That morphs into the back end of the year and the elections and what's happening in terms of the outcome of the elections, what that implies for the country going forward and for policy in 2025.
And just in terms of the market risk there, meaning that as liquidity tightens, people will be more focused on that and the potential deficit and the potential inability of the U.S. to spend and all of those issues.
Well, that and the issues around the Federal Home Loan Banks. The administration is constrained the advances that they can make to member institutions. There's discussion about paying less for reserves at the Fed and forcing that money out into the economy or somewhere else. There are, and as QT goes on, we have a lot of tightening of liquidity in the system to follow.
Kim Wallace, thank you so much for being with us. Wonderful to see you in person. Kim Wallace of 22V Research, thank you. And Katie, I am right now looking at the Fed's balance sheet. It has fallen to $7.7 trillion from a peak in April of 2022 of almost $9 trillion. So that's some significant declines, 1.2 some trillion dollars of coming in at a time where they're also raising rates. It kind of creates this issue. Do we understand how to game out the influence on markets from that decline in liquidity?
The influence on market and the messaging, of course. You know, we talk about and maybe poke fun at Jerome Powell for his communication missteps, but I do think it's going to be an interesting and potentially challenging needle to thread. You're cutting rates, but you're continuing to tighten via the balance sheet. How do you square that circle, and how much does that truly matter?
Well, that's what we just heard from Marvin Lowe, that he was concerned that the Fed is going to start cutting rates before they finish their quantitative tightening. He said that's the wrong policy to go at. This has been one of the big questions going into next year, especially at a time of deficits. Right now, doesn't seem to be that much worry right now, given the fact that yields have come in more than a percentage point. I mean, really, the idea that they've come in 1.15 percentage points since the recent peak in October for 10-year yields, 3.86%. That reduced the U.S. deficit a little bit. Let's see if they can keep that going. New York crude up about 1%, $74.69. Coming up next, we've got Julia Coronado of Macro Policy Perspectives as we await that key core CPI or PCE, data. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
2 hours from the most important data point of the last trading week of the year. That's what it feels like. There's another week coming after this, or so I'm told. Right now, we are looking at markets really kind of in stasis after a pretty tumultuous couple of weeks. S&P futures basically flat, down maybe 0.1%, but what we're looking at is still hovering around that 4,800 mark, 47.93. The Russell 2000, honestly, to me, has been the highest flyer, the most interesting of all of the pairs at a time where people seem to be shrugging off, Katie, all of the growth concerns.
Absolutely. That's playing out in the Russell 2000. You think about those small cap companies that really have just been getting hammered when we've seen previous episodes of growth scares. But they've been the outperformer. I am really interested to see how this market changes in about 2 hours' times. When we get those PCE figures, it is very much holiday trading conditions. Not a lot of liquidity to be found.
Which means we could get some pretty big moves at a time when we've seen at least some stability in the Treasury market compared to the recent volatility. 2-year, 10-year, 30-year, just seeing sort of this persistent bid in as we assess some of the weaker aspects of the market. I am thinking about Nike. I wonder how much something like that can really color people's perspective. 10-year yields 3.86%. We can see the 2-year yield 4.3%. Really a market shift lower as people price out the idea of 6 rate cuts next year. We're looking at the lowest 2-year yield right now, Katie, going back to May of this year.
It is just amazing. And if the equity market is overbought, what do you call the bond market? Because the rally that we've seen over the past 2 months has just been breathtaking to watch.
Which is part of the reason why people are interested in the fact that we have seen a little bit of divergence in the past couple of days between bonds and stocks. I do want to finish on currencies, given the fact that we are seeing dollar weakness pretty much across the board. Euro strength crossing that 110 line for the first time, going back quite a ways. We got back down to 106 after a while, and we've really seen steady euro strength. How much is this because of European strength? I don't know. The data not necessarily coming in all that strong, but it really is the dollar weakness story, which could be something of, I don't know, a surprise heading into the beginning of next year. I'm looking right now at the euro, the strongest going back to July of this year, Katie.
Well, it was exactly a week ago where we were sitting here with Damian Sassower, and I remember he told us over and over again about the dollar smile theory. Of course, the dollar does well when things are really good and when it's really bad. And if you think we're in the middle right now, maybe that means continued dollar weakness from here.
We can talk more about the dollar smile coming up. Dollar smile for Christmas holiday. Under surveillance this morning, the U.S. announcing new plans to target banks that facilitate payments for Russia's military-industrial complex. It's the latest move by the Biden administration to try and restrict Vladimir Putin's ability to fund Russia's invasion of Ukraine. Treasury Secretary Janet Yellen saying, quote, "We will not hesitate to use the new tools provided by this authority to take decisive and surgical action against financial institutions that facilitate the supply of Russia's war machine." Gotta be honest, Katie, I've been reading a lot about the sanctions on Russia. I don't know how effective they've been. Frankly, all of the companies that were told to get out of Russia, or that were required to as a result of sanctions, had to sell their remaining businesses at fire sales. And you know who capitalized? Russia, who took the mochaccino and made it like, a mochaccino, and then they sell it under the same basic umbrella.
And you think about where Russia stands right now. Basically, it's been able to continue to get new weapons, et cetera. So that would suggest that maybe those sanctions aren't as effective as many would like them to be in the Biden administration. Of course, we're approaching the 2-year anniversary. It makes sense at this point that the Biden administration, the Treasury, et cetera, really looking for more ways to make that pain felt by Russia.
And maybe direct some of the money to Ukraine because it's not coming from Congress, at least not yet. Nike shares, meanwhile, tumbling. The company announcing it's looking for as much as $2 billion in cost savings after issuing a weak forecast for the second half. The sportswear giant said sales in China fell short of expectations, while the company's CFO added there are, quote, indications of more cautious consumer behavior around the world. Nike shares down severely, 11.5%. You could see Puma, you could see Adidas falling in tandem, as well as Foot Locker and a whole host of others. I do wonder, we always ask this, how much is this specific to Nike? How much is this specific to a particular slice of the Chinese consumers that they sell to versus a real macro story that maybe is what Patrick Harker was talking about with real weakness?
Well, to the theme of the morning, those growth fears, I think the fact that, to your point, you do see a lot of competitors falling right now, Adidas, Puma, et cetera, suggests that at least investors are worried that this isn't just a Nike story, that this is an industry-wide story. And when does that industry-wide story turn into something that shows up in the broader economic numbers?
And maybe they're worried because there's nothing else to worry about, so maybe it's an excuse to...
I think it's December 22nd.
Yeah, I think so. I think that you're right. This one caught my attention, as I'm sure a lot of parents also read this, with conflicted feelings. Headset leading an $80 billion sell-off in some of China's biggest online names after the country imposed new curbs on gaming. China's top gaming regulator published draft rules aimed at clamping down on practices that encourage gamers to spend more money and time online. It's the latest crackdown from Xi Jinping's administration, which has long fought to curb gaming addiction. We can see Tencent shares down 12.4% and a whole host of others. I have mixed emotions here. On one hand, I'm not really for censorship. I kind of think, you kind of have to live and let live and give people that opportunity. On the other hand, as a parent,
right?
I don't know, if someone just took away some of the games and prohibited them from engaging with certain platforms, it would make my job easier. I understand that maybe I should just put better.
Maybe it would boost productivity, so to speak, but you can see really the surprise of these draft rules coming out in the share reaction. Really painful memories of 2021, of course, the last time we got that really broad-based China crackdown on the tech sector. I believe Tencent, that's its worst move lowers in one day since 2008, which we'll see if that's an overreaction.
Well, two things. One, this really raises questions about how much confidence people can have to invest in China's tech sector after it's really underperformed the U.S., given this kind of unexpected interference. But two, it raises a question on the commitment of Xi Jinping to the culture versus the economic backdrop of the country. Because for a long time, he's been kind of trying to push the culture aspect more, even at the expense of the economy. And now there's a feeling that maybe there's a little bit more of a push-pull, but not that much. And that's what this really shows, that still the cultural aspect reigning supreme on some level.
I think that's also why you're seeing this big reaction in the shares, because, I mean, it seems like the narrative that has started over the past couple months or so, of course, everyone came into this year expecting this to be a really great year for China's economy, or at least better. That hasn't been the case. There was some talk of maybe that would force Xi Jinping's hand, but just looking at the news this morning, it doesn't appear to be the case.
Meanwhile, we are about 2 hours away from the key data point of the day, which is core PCE. Joining us now, Julia Coronado, president and founder of Macro Policy Perspectives. Julia, what do you expect us to see at 8:30 today, and how much will it matter?
Well, I think what we're going to see is the consensus on our Bloomberg screens is a little bit stale. I think we're going to get a flat reading on core PCE inflation, the Fed's preferred gauge of underlying trends, and that will take the annual rate down to 3.1%. These are numbers that we already sort of had a foreshadowing of from the CPI and then the PPI, and even Chair Powell cited the 3.1% number in his December press conference.